He's going to give us a couple of minutes of prepared remarks, and then he's going to join me down here at the seats for a bit of a fireside chat. So please join me in welcoming Randy.
Thank you, Brian, and thank you everyone for coming in. I guess we're kicking off day 3 of this pavilion. So thank you for coming in and hearing our story. Again, my name Randy Smallwood, CEO of Wheaton Precious Metals. Been with the company since we founded it back 21 years ago when we created the streaming business model. We are essentially a pure streaming company. That's all we focus on. We've got a few ancillary royalties we've picked up, but the streaming model is just a better business model. So I will pounce through a bunch of slides here, but anyone's got questions, this is the perfect forum to ask them, and I'd love to engage with you. So cautionary notes, there will be some forward-looking statements. Understand the risks of those forward-looking statements. Who is Wheaton Precious Metals? It's, as I said, the first ever streaming company. We created the model back in 2004. We were focused on the silver space, but in 2013 we started expanding into the gold space. The key is we are focused on precious metals. A very, very strong focus on precious metals. And the streaming model is a unique model where we supply capital to the mining industry, but when we supply that capital, we supply it for a share of the metal that's being produced at the mine. So if a mine grows or expands or has exploration success or expansion potential, we continue to get our share, whatever representative share is of that, as that mine matures and grows going forward. And when we get that metal delivered to us, we actually make a production payment on a per ounce basis. So it's, again, one of the other advantages compared to royalties and owning bullion is that we do have that base production payment, which gives you leverage. We really focus on investing into good quality assets, mainly because we don't operate those assets. And so we need to make sure that they're assets that are profitable for our partners. We put a lot of effort into monitoring the health of our partners. It's something that's so incredibly important. The healthier our partners are, the healthier we are. And so we're constantly reviewing that during the due diligence process. But once we've invested, we visit every mine at least annually, and we're constantly making sure that there's healthy profitability on the other side. Again, one of the advantages of a streaming agreement, a streaming partnership, is that we work with our partners to unlock value. So if there's adjustments that need to be made to a contract in order to improve profitability, we're not a charity, we don't give things away, but what we do is try and do everything we can to make our partners stronger. That gives us high quality assets, a very important part of it. 83% of our production comes from assets that are in the respective lowest half of their cost curve. So that's to say, when we get gold from a copper mine, those copper mines, 83% of that production falls into the bottom half of the respective cost curve, the worldwide copper cost curve. So it's very important. It's one of the key things for us. As I mentioned, commodity price leverage, the fact that we have a base production payment on a per ounce basis gives us leverage over just owning bullions or investing into royalty companies. Predictable costs. Again, one of the huge advantages to Wheaton, especially from a generalist perspective, is we take so much risk out of investing into precious metals. Our costs are fixed. Our capital costs are defined in the contract. Our operating costs are fixed and defined in the actual contract itself. And so there's no surprises. We can accurately forecast 5, 10, 15 years out what we will be paying on a per ounce basis. It means that we are not subject to inflationary pressures that the operating mines typically do suffer. When commodity prices climb, costs usually chase those commodity prices shortly thereafter. Not the case with the streaming company. I mentioned the exploration expansion upside, the optionality, and a good strong progressive dividend that we contribute. Probably there's a whole bunch of numbers in here. We had a good year last year, put $1 billion back to work, generated really healthy cash flow. We haven't released our year-end results yet. That's about a month and a half away, but I can tell you it was by far our strongest year ever. Probably the one that stands out the most here is that I think we passed $60 billion US in market cap yesterday. We have 45 employees. My partner, Haytham Hodaly, our president, sitting in the crowd here, you're looking at 5% of the company right here from an employee base. It's again amazing how efficient we can be in terms of managing our investments, staying on top of our portfolios, looking for opportunities, and keep the G&A very low. And so it's a good, strong team, and all sorts of other capacity. There's another bunch of highlights there, but we can go over that. But I mean, the one that I am excited about, and it says 40% down in the lower left corner in terms of growth over the next 5 years. I'm pleased to report that one of the things that we've seen over the last year is a couple of new acquisitions, but most importantly, a huge number of our partners accelerate growth plans, and so that number is even better. And so the asset base spread around the world. We do have an America-centric focus, mainly because we spent the first 10 years of our life focused on silver. Most silver, Mexico, Peru. Latin America produces most silver. So there was a real focus there. But as we've stepped into the gold space and the platinum and palladium space, we've stepped into Africa. We've now got investments in this region, Platreef, Kurmuk, and Koné in Africa. Pretty exciting, but still a pretty strong asset base, and again, a nice, efficient asset base. We're not believers in buying lottery tickets and sticking them up on the bookshelf and hoping that one wins. We really focus on investing into quality assets with ounces behind those assets. Our partners, the streaming business model works for everyone. We are a source of capital for the mining industry. The mining industry, we are blessed, always needs capital. Now, larger companies, of course, are generating good, strong cash flows and don't need that support currently, but what we've been doing a lot more recently is smaller development companies helping fund and build that going forward. But you can see our partners include Vale, Glencore, Barrick, Hudbay, Newmont, all the way down to companies the size of Elmina, Artemis Gold, Montage, Generation Mining. The key point here is the streaming business model as a source of capital to help build and grow companies works for everyone. If there's one slide that I think differentiates us from our peers, the traditional royalty companies that have now stepped into the streaming space, this is it. First off, the first slide on the left, when you invest into Wheaton, you are investing into precious metals. A lot of our peers have oil and gas and iron ore and copper. I'm going to tell you that that is the most expensive oil and gas, the most expensive iron ore, the most expensive copper that you can buy, because you're buying that when you buy their shares with a precious metal multiple on top of that. We don't focus on that. I understand the trick. I can go buy cheap cash flow, bring it in here and trade it at a higher multiple. That's not creating real value. That is not creating real value. Our focus is precious metals. This slide, of course, showed 60% gold and 40% silver. That was done last year. Silver, of course, has dramatically outperformed even gold over the last especially the last 6 months. I'm going to predict that by the time we come out with our updated guidance in about a month, we may be back to about 50-50 gold, 50% gold, 50% silver. We do have a little bit of palladium. We're going to start getting some platinum from the Platreef mine here shortly, and we've got a wee bit of cobalt. The center graph here shows the reserve and resource life. Again, one of the huge advantages of the streaming business model, we're a precious metals company, but most gold mines have very short reserve and resource lives. They only need, low capital intensity means they only need 10 to 15 years of reserves. Over 2/3 of our production comes from copper mines. Copper mines are very capital intensive, need huge reserve and resource bases. We have one of the biggest, one of the longest life reserve and resource bases in the entire precious metals industry. As you can see, 27 years of reserves, 14 years of M&I, and another 23 years of inferred. And then the farthest one, as I've already mentioned, 83%, including 73% from the first quartile of the respective cost curves. By far the highest quality portfolio, not only in the streaming space, I would argue for a big diversified company of our size and scale, probably the highest quality portfolio in the entire precious metal space. This is the one that excites me the most, because what we've seen is a large number of our partners step forward with more aggressive growth plans. With the high gold prices that we've seen, the high silver prices we've seen, we were forecasting 40% growth. And 2005 or 2025, sorry, our guidance was 600 to 670. It looks like we're very close to the top end of that. We had a really good fourth quarter, and the first 3 quarters clearly pointed us in that direction. But our original guidance had us climbing up to 870 by the end, over 5 years, by 2029. I am now confident, and we'll come out with our updated guidance in a year, but I am now confident that we will be over 1 million gold equivalent ounces per year of production, the first company of our type to ever get to that level of production by 2029. We've made 2 new acquisitions in terms of Spring Valley and the Hemlo mine, and then on top of that, aggressive growth plans from Salobo, from Platte Reef, from Artemis at Blackwater, from Aris Mining, all the way across the board. We've had a huge number of our partners dramatically accelerate expansion plans to push forward and take advantage of this price environment. We, of course, reap the benefit of that. So 1 million ounces a year by 2029. You can take it from me, right, Haytham? Good, strong growth profile, 50 to 60%. And again, this will be updated formally in about a month. The balance sheet is strong. Well over $1 billion cash on hand, $2.5 billion available if we ever need it, but we are generating currently around in excess of $2 billion a year of free cash flow. Again, with very low G&A, no buried sustaining capital costs or anything like this. It's a very, very simple company to understand. All sorts of capacity. You can see there, the fact that we have that production payment means that when commodity prices go up 50%, our cash flows go up 58%. Again, the advantage of streaming over royalties. It delivers better returns to our shareholders. Benefits to the mining partners, there's all sorts of benefits. Why do people do streams? Right now, it's the most attractive source of capital. Initial value is the arbitrage in value, especially from a base metal mine. Taking the byproduct gold and silver from a copper mine, silver from a lead zinc mine, and bringing it into our company, there's a difference in valuation, right? Some of that has to do with the fact that we minimize risk in terms of how we structure these agreements so that we have no cost, no risk of cost inflation. But nevertheless, that value creation is the first step in creating that value, and we share that arbitrage with the operators. We, as a streamer, are the only way that you can equity finance, and the finance is based on the value of the metal, not your shares. That's the huge attraction to streaming, especially in today's world when you're seeing junior development companies trading at discounted net asset values, or net asset value multiples. In fact, and this is the first time we've ever shown this slide, and this was pointed out to us by a potential partner that we're in the process of working on. Everyone knows the Lassonde curve, which kind of highlights the fact that the exploration excitement, then when it comes to funding and building a project, how it usually penalizes shareholders, mainly because you have to finance by issuing shares and diluting out your current base. On the right side, we have a graph of Montage. It's our partner down in Côte d'Ivoire, the Ivory Coast. You can see when they financed, we did a full project financing through a stream, so they did not have to issue a single share to get their mine built. And on top of that, they don't have any debt. They didn't have to go out and go to the banks. They've structured it all through a creative stream structure that we came up with that allows full project financing and allows them, by the end of this year, to start producing at least 300,000, looking like it's going to be more than that, 300,000 ounces a year, and to start production at a cash cost below $1,000 an ounce with zero bank debt. We'll get 20% of that gold for the first 7 years, and then we drop down to 10%, then 5% going forward. Excellent win-win partnership. All you have to do is look at that graph to say that there's a lot of happy shareholders at Montage because they didn't have to suffer the Lassonde curve, the challenge of that dilutive part of building a mine going forward. This is why streaming is becoming ever more popular. Again, the arbitrage that you see between, when we bring it into our company, it trades at a higher value, so we share that arbitrage with the operators and with the developers. And then the improvement in IRR also really reinforces that. So why invest into Wheaton? My whole objective is to present the best way to invest into precious metals, to reduce the risks dramatically from a traditional mining investment, but still keep all the upsides, still keep all the benefits, focus on good, strong structures. We're not not buying lottery tickets. You guys can go out and buy lottery tickets all you want. We're focused on investing into solid projects, solid ounces, a nice tight portfolio. I don't know if we'll ever have over 100 projects in our portfolio, but what we will have is a good tight portfolio of assets that will continue to deliver growth on a consistent basis. And as you can see, we check all the boxes. We have leverage over the traditional royalty companies. We are focused on pure precious metals. Again, the oil and gas and iron ore and copper that you see in some of these are peers. It's the most expensive oil and gas and iron ore and copper that you can buy as an investor. It makes no sense to carry that within your investment portfolio. Bullion and ETF and then the miners itself. Miners just have more leverage and higher risk, and so it's a challenge. So I think the evidence shows for itself in terms of our performance. So I think that's the last slide before we can sit down and take some questions. We check all the boxes. Thank you.
Thanks for that, Randy. Maybe as you make your way down to the chairs here, if anybody has a question that they'd like to ask, please raise your hand so a microphone can be brought forward. Or maybe just you and I can get the ball rolling here, Randy. A couple of bits and pieces. As you mentioned, it's the first time you've debuted your Lassonde curve busting theory here. And a couple of days ago, I was up on this stage doing the Mining 101, and the Lassonde curve did feature quite prominently. One of the things that I was speaking about then, and perhaps I'd like you to speak to from a case study perspective, is do you think that a portion, not just the financing part and the dilution that comes from that, of the lack of dip in the Lassonde curve comes from you've done your due diligence, investors have had some uncertainty removed from the prospective investment that they're going to make, and maybe the case study I'd have you walk through is, you did a deal with Spring Valley that had relatively little information available in the market.
Right.
You obviously had a due diligence process that you went through to get comfortable with it. Can you maybe walk us through what that looks like, and maybe is that due diligence process from Wheaton Precious one of the things that you also add to the market?
There's no doubt. I didn't mention it at the start, but I'm a geological engineer by background. Our team of 45 employees, about 40% of that staff is technical in terms of background, either geologists, metallurgists, process engineers, mining engineers, or social scientists, which of course is a very important part of operating a successful business in the resource space. And so we are very, very technically driven. We take pride in not only unlocking value and looking for assets that have high operating margins, but also structuring assets to make sure that we protect our shareholders' capital, making sure that we have parent guarantees, making sure that we have security on the assets, so that if something goes wrong, especially politically, political risk is a real issue. We have permits pulled all the time. We've had projects go through this. Making sure that we have protection so that we can get our money back if it ever comes down to that. Not that we would profit off of it, but at least we have the right to get our money back. As I've had to remind a number of companies that come to approach us, we stream gold, we stream silver. We do not stream political risk, and so make sure you preserve and put that structure in place. So it's one of the most important parts of the due diligence process. But as you say, diving in and diving deep, building a reputation for, and a wise man, a mentor of mine, someone that I worked with very for many, many years, and who I probably credit more with the creation and streaming model, Ian Telfer. He used to tell me, he says, I don't need you to tell me which mines to buy. I need you to tell me which mines not to buy. So celebrate the no's, celebrate the ones, and every once in a while we'll have a celebration lunch or dinner in the office or something like that, and we'll all get together and say, well, that was a good quarter, well done. And I usually start off by, first off, happy that we made this acquisition, etc. But hey, let's celebrate the ones that we stayed away from, because we were wise enough and smart enough to be able to put those off to the side. So, you make sure that that's the continued focus and build that reputation. Reputations are very fickle. They're very, you can lose it so fast. And so you really can't take your foot off the pedal in terms of driving for that technical excellence and pushing that. There's no doubt that helps. And we saw that probably even more so at Hemlo, where Barrick sold it to, at that time, Carcetti Capital, which was a shell, with a couple of relatively, I'm going to say young, but they were known in the industry, but not established in the industry. I don't know if that deal would have happened without Wheaton coming in and saying, hey, first off, we're happy with the team. Second off, we're happy with the asset. We think there's incredible upside potential. And so it was an excellent example last year of us being able to deliver some of that comfort, I guess, in terms of that. If it's good enough for Wheaton to say that it's, that's worthy of investment, then it's good enough for the investors. Again, equity is incredibly dilutive, especially if you're a single asset development company. And so that's the huge attraction, and that's when I talk about the cure for the Lassonde curve. It's literally the fact that there was no equity that had to be issued, and all of a sudden investors realize that if they're going to ride the wave of this incredible gold ore body and bring it forward, they have to step into the market. And the tradition has been is that the Lassonde curve, the dip in the Lassonde curve, always happens when you're out sourcing equity or sourcing debt. And shareholders just love knowing that you're going to come to market because they're going to get themselves set up and prepared for it. There's a different way, and Montage is an excellent example of how we can actually deal with that so that you can actually deliver continual growth and value to your investors right through the whole cycle, from exploration, from discovery, to feasibility, to permitting, to construction, to production. It's incredibly powerful.
Maybe we'll switch over to one of the other themes of your presentation, which was the growth there. What are your key growth drivers in the company portfolio over this 5-year outlook, and which assets do you think offer the most sort of upside to be unearthed, or less obvious upside coming in?
Yeah, so as I mentioned, a large number of our partners have accelerated growth plans. And so our corp dev team has continued to deliver. I mean, we've averaged about $1 billion into the ground or into commitments over the last 5-6 years per year. And so we've got a good portfolio of assets that are now coming into production. And all of those assets had expansion plans and, get the first phase going, then phase 2, phase 3. What we've had to bring across the board is that consolidation. Probably one of the ones that stood out the most is Artemis at Blackwater, where instead of getting to phase 1, running for a while, building up the capital pool to fund the phase 2 expansion, et cetera, with this price regime, they can now fund that full expansion just because of the operating cash flow they're generating. And so they are now pushing towards, by 2028, being at full production levels, which is 2.5 times where they are right now. We weren't expecting that until 2033, 2034. So that's a nice, pleasant surprise. Platreef, Robert Friedland, of course, and his team down in South Africa, dramatically ramping up and accelerating, bringing that project on. Again, recognizing that there's a good, strong market for platinum and palladium right now. So let's get the best platinum and palladium mine in the world up and running. And they've just started production. We just received our first shipment from Platreef, but it's at a small scale. They've got to get the last shaft up and running and go forward. They're committing towards 10.7 million tons now by 2030, somewhere in that range, per year up the shafts from a disruptor project that's going to do a total reset. There's a number of other assets. Salobo has to be mentioned. Salobo is our flagship asset, partnership with Vale, one of the strongest, best copper mines in the world. A fantastic partnership, very profitable for Vale, also very profitable for us. We get 75% of whatever gold is being produced there. They've just finished their phase 3 expansions up and running nicely, and they've just announced during their Vale Day that they're going to do coarse particle flotation, which they expect by 2029 will add another 15% in throughput capacity to that operation. Now, I think they're going to chase some lower grade material just because there is a bunch of lower grade material. So I think it'll only be about a 10% bump in metal production for us, not 15%. But 10% of Salobo is significant. Last year we received over 250,000 ounces of gold from that mine. And so bumping it by 10%, again, not part of any forecast that we have. This is a commitment they only recently made. And so, as I said, on a path to 1 million ounces a year, which has always been a personal objective of mine ever since I took over as CEO, and excited to see it so close on the horizon. Dramatic growth from this year, we're in the 600s, next year probably 700s, the year after that 800s, and then up to 1 million. So 2029 is going to be, well, every year is going to be exciting with a number of new mines coming on.
And with the increase in silver, gold, and even copper prices over the last little while here, would you say that that has somewhat reduced new deal opportunities in terms of producing companies now having more free cash flow to be able to deploy on their own projects, or has it increased inorganic opportunities because there's developers that want to get in that queue faster and they're sensing an opportunity right now?
So, our opportunity set changes over time. Different economic environments sort of drive that. We currently, where we're seeing most of our opportunities are the single asset development companies, the ones that don't have access to operating cash flow. If you're in the copper space, if you're in the precious metal space, if you're operating in that space, you should be, producing more than enough cash flow to fund your growth needs, unless you're going to step up and make a major acquisition or a major expansion or start up a second mine. But just about our entire opportunity set currently sits as single asset development companies. The higher prices are actually driving accelerated plans and investment into the space. Now, that being said, it also comes with the fact that we're paying more for silver and gold than we ever have before because of these higher prices, right? They go hand in hand. We buy it in the market of the day. Now, we are tempering back our longer-term numbers because of the run-up, especially in silver. So we're tempering back, the long-term number relative to the spot price. But it's still a very healthy price. And I'll be honest, it's the highest that we've ever paid for gold or silver in terms of new opportunities. But that's the market of the day, and so you have to reflect and capture the market of the day and deliver that value to your partners, both existing and future. So we're seeing a lot of that. What we are also seeing with these high prices is a number of diversifieds are starting to look at their non-core byproduct production, the big guys, and they're saying, I wonder if I could raise a couple of $1 billion just by selling off a silver stream or a gold stream. Because the big diversifieds aren't interested in precious metals. They're in the commodity business. They're not chasing precious metals. And that's an excellent way for them to actually fund their own growth by selling off. Again, portfolio optimization always says that if you need capital, start looking at your non-core assets within your portfolio and see if you can crystallize and turn that into available capital that funds your growth into your core franchise going forward. And so we are starting to see a bit of that. We've had a few reach outs there. Then the other side is supporting on M&A transactions, similar to what we did with Hemlo, similar to what Franco did with Discovery Silver in the Timmins camp. Being supportive really helps, especially new investors coming into the space, knowing that there's a second set of eyes that has gone over the data, that has looked at it, and has been worthy of investing, felt it worthy of investing into. I mentioned the comments in terms of equity and how it competes. Issuing shares versus that. We're always happy to support, and in fact, a lot of our recent deals, we've actually come in with a bit of equity support, mainly because why not? We're buying it at such a discount to the real value of it. Again, the huge attraction of a stream is that it's valued based on the value of the metal, so you're getting it at 1 times NAV, irrespective of what your shares trade at, and that will continue to open up opportunities for us. The higher copper prices is also going to open up some opportunities. I do expect that within the next couple of years we're going to see some multi-billion-dollar. In fact, I can tell you that we've put out some streaming proposals that are the biggest ones we've ever put out, measured in the billions of dollars. Copper projects tend to take $5 to $10 to $15 billion to get built. Very, very capital intensive, and so I can easily see some of the largest streams ever being used to help fund some of that copper production over the next 4 or 5 years.
We have perhaps 30 seconds if somebody has a burning question from the audience. Well, if not, please join me in thanking Randy for his time today.
Thanks, Brian.
Well, ladies and gentlemen, thanks for sticking with us this morning. Our next presenter is Paul Brink from Franco-Nevada, and I guess with no further ado, why don't you take it away with some prepared remarks, and then we'll come down and have a bit of a chat.
Thank you, Brian. Delighted to be here. It's such an exciting venue, and thank you all for attending. I am looking forward to introducing our company to you. Not quite sure where to point it. Yeah. This is like me this morning after a late night. Took a little while to warm up. There we go. Please heed the cautionary statement there. I will make some forward-looking statements. Franco-Nevada is a gold royalty and streaming company. We've been in business for close on 40 years now. Our method of investment, we provide capital to build new mines. A lot of those are gold mines, and often what we take is a royalty on the gold mine. We put up capital, and then we take a percentage of production for the life of the mine. A lot of those are also very big copper mines, and often the way we structure it with a copper mine is as a stream. When the copper mine is producing gold as a byproduct, the stream gives us a percentage of the gold that is produced, again, over the life of the mine. So whether it's a stream or a royalty, it's a very similar investment. It's a percentage of production for the life of the mine. It's been a tremendously successful business, both for ourselves and for the companies that we financed, and I look forward to telling you a little bit more about it. We invested in assets across the world. There are roughly 120 producing assets that we're invested in, but more than 400 assets around the world that we now have an interest in. A lot of those are projects that are under development. A lot of them are exploration properties. You'll see a lot of what we've done is in Canada, the US, Australia. A lot of those are the gold royalties, but then a lot of the big streams have been in South and Central America, Panama, Chile, Peru, Brazil, but we're also invested globally. One area we haven't done a lot of investment yet is here in the Middle East. We're tremendously excited, looking forward to potentially investing in this region as well. You'll see of the assets that we invested in, many of them are those big copper assets that I speak about. You'll see Candelaria there. It's an asset run by Lundin Mining in Chile. We get the gold byproduct from that. There's Antapaccay, again, a very big copper mine run by Glencore, top of the Andes in Peru. Antamina, similar, big copper zinc project that's run by BHP, Glencore Tech in Peru. We get a gold stream on those. Also a number of large gold-silver assets. One of the bigger ones, Guadalupe Palmarejo, that's run by Coeur in Mexico. Hemlo, you'll see there, asset that Randy had spoken about. They've put some money into that as well. We've had royalties on that property for many decades. It's a big gold mine in Canada. In terms of where our revenue comes from, you'll see the split there, spread all in good mining countries around the world. And in the middle of the chart, you can see the commodities. Most of what we're invested in is gold and silver, PGMs, precious metals. But that model of investing in a mining asset, providing capital, and then benefiting in the production of the asset, particularly as you mine deeper and you reveal more and more of that ore body or resource, it applies across all resources. So we are invested directly with copper royalties on copper assets. We've invested in the oil and gas industry in Canada and US. We've invested in iron ore assets with Vale and with Rio Tinto, all of those that have done very well for us. In our model, as I explained, we take a percentage of production. And so it's a top-line interest. The beauty of that is as the commodity prices go up, we're not exposed to the cost inflation that often eats into margins of operators. So it's a business that over the long term really delivers value to shareholders because you're not losing margin due to cost inflation. We're tremendously proud of the returns we've been able to generate. Our company was public for a period, roughly 18 years. Then we were acquired by Newmont. We were part of Newmont for about 6, and then we went public again at the end of 2007. So we're now, the numbers match. We've been public again a second time for 18 years. These are returns over that 18-year period, and I'm making it very easy for you because the average annual return we've earned is 18% per annum for 18 years. Very proud of those returns. Like to contrast that with the NASDAQ, all those high-flying tech stocks. Our company has been able to outperform the NASDAQ, the S&P, the gold price, any relevant index. And really what it is a reflection on is the power of investing in the mining industry, the power of, if you select good resources, being able to participate in the expansion of those resources over the long term. The tremendous value you can create as a very patient investor in the mining space. With those returns, we've been able to increase our dividend every single year. That's the objective of our board, that our dividends are sustainable and progressive. We will be making a dividend announcement in the next coming weeks. I can assure you it will follow that trend. In terms of the optionality investing in deposits, and I mentioned it a bit earlier on, our model is somebody's building a mine. We will value the reserves today and we'll pay a very fair price, NAV, for those reserves at a very low discount rate. But what we're looking to do is partner in that asset, so as you mine deeper, if you reveal more ore over time, that we get to participate in that upside. It's very much a win-win business model. If the operator reveals more ore, most of that is attributable to them. Some of that is attributable to us. But how does that play out over time? I mentioned when we bought these assets back from Newmont 18 years ago, there were set mostly gold assets in that portfolio. If you look at the reserves that were there at the time, what's been produced since then, and the reserves that are there today, there's 3.6 times as much gold today as there was then. I point that out because often we're a low risk way to invest in gold. Another low risk way to invest in gold is buy the gold ETF. But with a gold ETF, if you pay for an ounce, you get an ounce. 18 years later, you'll still own an ounce. If you buy Franco, 18 years later, you get 3.6 ounces for the 1 ounce that you bought. This is a quick snapshot of our growth. I won't go into detail. One of the bigger assets that we invested is with First Quantum, very large copper mine in Panama. It did have protests from the community a couple of years back. The mine is currently shut. First Quantum is working with the government to get that mine reopened. I think that will be successful. I'm very hopeful that we'll see a restart of that mine sometime this year. That, along with the other organic growth in our company, would give us potentially 50% growth above the level that we're at last year. On top of that, we've got some very exciting assets that we're invested in that can potentially make that growth even more powerful. I'll flip to those. There's a quick chart that shows these are the assets that are in our portfolio, the bigger of the assets that are in our portfolio that are not contributing and that we don't have built into our 5-year growth, but could be potential growth above and beyond 5 years. You'll see there are a whole number of them. If you take the total ounces there, there's 7 million ounces. Today's gold price, $4,500 gold. You're looking close to, that's probably $30 billion worth of value that could be added to our company that is not yet built into the value. Two of those bigger assets that you could see, both big copper gold assets. The one, Cascabel, big development property in Ecuador. We have funded that in early stage. We're currently funding, they're at a pre-feasibility stage. We're currently funding it to feasibility. They've just received a takeover bid from Jiangxi Copper. Jiangxi, one of the biggest Chinese copper players, a very experienced mine builder. So I expect that that asset will soon move into very strong hands and will be moved into production quite rapidly. The other is an asset, New Prosperity. It's in Canada, probably one of the best undeveloped copper assets in Canada. The owner, Taseko, looked to develop it 12 years ago. They couldn't get permitted at the time. Their issue was that they didn't have a constructive relationship with the First Nations. They are now working to resolve that. They had a bit of a breakthrough last year. First Nations, they've now done a deal where the First Nations can buy in and ultimately become 20% owners of the asset. So I think that'll hopefully change the relationship, and then you could see that asset also move into production. Just two examples of what could be very big growth drivers for our company. A big part of what we do when we look at assets to invest in, obviously it's technical due diligence, trying to figure out what assets have defendable economics, what assets have potential large upside, but also make sure that the operators, the design of the assets has minimum impact on the environment and also has a net benefit for the communities in which the assets will exist. Fortunately, I have a very good track record of doing that, and as a result, we get very high ratings from all of the ESG agencies, which we're very proud of. And I'll finish off just to say we're very active investors, probably one of the most active in the mining space. While I've been with the company, well over $10 billion that we've invested in different assets across the world. In the last 2 years, that's been more than $3 billion we've put to work. We're currently sitting on $1.8 billion that's available for us to invest. So if you have good projects, in particular, if you have good projects in Saudi, we would be delighted to have a discussion. We're looking to deploy some of those proceeds into this region. With that, I'll take any questions, Brian.
Well, maybe as Paul takes a seat here, if anybody has a question, please raise your hand so that a microphone can be brought forward to you. Oh, just the front here. Just 1 second. Wait for the microphone.
Thank you for that. It was an eye-opener. So what stages were you or are you interested in investing? Is it exploration, and is it production stage? Is it, what stage would you be interested in? Or if you could give us an example of what stage you got into with other companies.
Yeah, in short, we'll invest at various stages. As you would have seen from the range of assets that are invested in, we're invested in quite a lot of exploration properties. We are invested in development properties and then a lot of operating properties. Obviously, the biggest capital that we put out is when you've got a project that is construction ready. We're part of the project financing. But as some of the examples I would have mentioned, when projects have done enough work to establish what the economics are, so often a pre-feasibility stage, we'll put up capital that can advance that project from pre-feas to feasibility. So I'd say that's a medium amount of capital. But then for very attractive exploration properties, we will often do royalty financing, so provide you the financing that allow you to run the next phase or a couple of phases of a drill program. Obviously, those are smaller dollars, but we do participate across the spectrum.
Do you have any other questions from the floor for Paul? Maybe I just pick up on one of the last points you made in your prepared remarks there. You recently did a transaction with Côté, and in order to do that transaction, you sold most of your bullion inventory to do it. How do you decide when you're looking to do a deal, whether it's inventory sales, raising debt, or raising equity to finance a new acquisition in the space?
Great question. Thank you. You know, the history of our company as a smaller company was we would raise equity, make investments. Stock performed tremendously well on the back of that, and so we had always said to investors, if our stock is up 50% from the last time we raised equity, expect that we will raise more equity because we always see good opportunities. Shareholders were always very happy when you've provided a 50% return, and so that historically had been our model. Our thinking on the industry is investing in resources. It's a highly cyclical industry, and so we have always been quite debt averse. We've always said, don't carry debt through the cycle. The best transactions happen when there's a scarcity of capital in the business, and that's when you want to put a lot of capital to work. If you're carrying a whole lot of debt when there's a downturn in the industry, you don't have any money to spend. So we sometimes use debt at the bottom of the cycle, but we've tried not to carry it through the cycle. So our preference has been equity over debt over time. But actually, we haven't raised equity for the last decade now. As the company has become bigger, we're generating so much free cash flow that it really has been our cash flow that we have reinvested into projects. As Brian points out, we actually liquidated some of our bullion to make this last investment. The way we run the company is if we're generating cash, we like to carry at least $500 million of cash on the balance sheet, so it's available for transactions. Above that level, we'd rather build up our exposure to bullion. We're gold bulls. We're trying to provide shareholders exposure to bullion. So above $500 million in cash, when we've got more cash coming in, we just buy bullion and we'll sit on that bullion until there's a good opportunity. In this case, there was a great opportunity. We sold some of that bullion so that we could fund the deal. It worked out tremendously well. We made a very big gain on that bullion, and so we'd like to play that out again.
One of the other things that you highlighted is you have a fairly global view when it comes to transactions, but many of your more recent deals have been North American gold assets. Is that a strategic decision? Is it luck of the draw, you go where the deals are, or is it more a portfolio diversification or concentration for political risk security?
Overall, we're trying to build a company that is low risk for investors, and that means at low risk in terms of the model, diversified assets, not exposed to cost inflation, but also making sure that the bulk of the assets are in good mining jurisdictions, low political risk. Canada, the US, Australia have been tremendous jurisdictions over time. Where, as you can see, we're open to many other jurisdictions, but in particular, if we can be exposed to those three, anytime we get an opportunity, it's top of the list. We love that exposure. So delighted that over the last couple of years, we had opportunities that let us invest more in Canada and in the US.
So, sort of as per what we were talking about before, as you showed in your presentation, there's some fairly exciting growth coming through in the space. If somebody was to ask you just kind of quietly, what's the asset that you think is underappreciated by the market that's going to drive sort of underappreciated growth over the next 5 years? What's the dark horse in the race?
Well, we've spoken about a couple of the big drivers, Cascabel and New Prosperity. Maybe one of the dark horses, this is a deal we did probably a decade ago, 2015. Ring of Fire is an area in Ontario, Northern Ontario, really hadn't been explored in the past. The reason is it's largely muskeg. So that is, you can't traverse it during the summertime. You need to wait until it is frozen in the winter. And then in the wintertime, you can fly in drill rigs and drill on what is then the frozen permafrost. So it hasn't been explored much in the past. A decade ago, there was quite a bit of exploration, all of it helicopter supported, and in a short amount of time, there were great discoveries made. The largest were chrome, the discovery of the second largest chrome resources outside of South Africa, but also nickel, copper, gold. It is an immensely prospective district. Cleveland Cliffs had spent $1 billion consolidating that whole play, probably 2010 through to 2015. And then as the markets came off in 2015, and they were facing a liquidity crunch, they were forced to sell it. We had put up the money to buy it at the time. It wasn't a lot. It was $25 million. We'd actually funded a company, Noront, to buy all of those assets. We took a loan and a royalty. Since then, our loan has been repaid back. Noront has been acquired by Wailu, which is Andrew Forrest of Fortescue Resources in Australia. They're now looking to develop that region. It's called the Ring of Fire. It is tremendously prospective. What needs to be built to access it is a road. The Ontario government is very supportive of the project. They are lobbying the federal government so that the two of them together will fund construction of that road. But I think it will open up an entire new mining camp in Northern Ontario. We have a royalty interest that covers the entirety of that camp.
Maybe going back to sort of some of the decisions you make on deals, how do you weigh up the risk-reward profile when you invest directly in the equity of juniors like G Mining or Discovery Silver versus taking a royalty or a stream on a large producing mine?
We're active doing both. I've mentioned already a lot of those large mines, Candelaria, Antamina, Antapaccay, some of the world's biggest copper mines. Where we have been providing financing that is low-cost financing to, in those cases, very big major producers. But the other side of our business is to say amongst the smaller producers, how can we help them be successful? And so we've had a strategy of saying, try and find the really good teams that have good assets and not only provide them financing on a transactional basis, that is one financing amongst a bunch that they would do, but actually position ourselves as their financial backer. Say to them, we have your back, we'll provide whatever you need, stream, debt, equity to make sure that you're properly financed. And we tell the market, we are the backers of this company. What we're trying to do is take the financial risk out of the equation. And in doing that, we've really been able to differentiate those companies. And you've seen G Mining and Discovery Silver, Brian, I believe, they really are market darlings within their space. It's been a tremendously successful strategy. We're looking for more good teams that we can back and hopefully repeat that success.
And maybe a different form of equity investment. It's been my experience in the space for a while here that smaller royalty companies don't tend to have a long shelf life. They do tend to get scooped up by the larger royalty companies. What's your view on consolidation, both at the smaller end of the royalty scale and then with some of the larger companies perhaps picking off some of those small ones? Consolidation in the space, how does that affect deal flow? How does that affect the way that you think as well?
Amongst a number of the smaller royalty players and a number of them out there, it's not always the case, but often the interests that they are buying are longer dated projects. And one of the things we find in the industry is when we look at projects, if you're looking at the grade or the output, the recoveries, what production might be, I call all of those 2%ers. We might be 2% higher, 2% low, but we can get those things, we can estimate them pretty accurately. The hardest thing to get right is timeline. Every junior producer, when you look at their PowerPoint presentation, they're going to be in production 3 to 5 years. The reality is that number is more like 15 to 30 years for those projects to come to fruition. So with many of the junior players, they expose to longer dated projects, and when you're small scale, that can really hurt. So what you've seen over time is the juniors consolidating so that you've got more diversification amongst the assets. If you've got a few producing assets, you've got more of a timeline to allow that those longer dated assets come to fruition. So I think I see all the sense in the juniors consolidating. I think you will see a lot of it. To date, you haven't seen too many of the seniors step into that space of acquiring the junior players. Particularly for that reason, I think we often see better value in buying assets that are closer to cash flow. We're able to do that. They're often bigger transactions. You need to pay a higher price. But ultimately, we find we can get a better rate of return because those cash flows are far more near term.
And maybe along similar lines here, we're at a fairly global forum here, and many governments around the world have shown an enhanced interest in getting permits done faster. Now, whether there's a higher royalty or something like that that comes on the back end, we can put that to the side for the moment. But as permitting timelines are at least being touted as being shorter, are there any assets in your portfolio that you have a feeling that may come sooner than the market expects, or by the same sort of token, are there any jurisdictions that you're more likely to look at now because those permitting regulations have become more transparent and faster?
Yeah, a couple of different jurisdictions where that's happened. A couple of assets in the U.S. that have received their permits just in the last year with the change in outlook. One of those is Stibnite Gold, Perpetua Resources, probably the best undeveloped gold property in the U.S. We have a royalty on that because it is gold and antimony, which is very attractive to the Department of Defense. Department of Defense in the U.S. pushed that project through. It's got its permits. We have permits on Hudbay's Copper World project in the U.S. It took many, many decades for it to achieve its permits. Finally, in this environment, it has its permits. It'll now start moving to completing the feasibility going into production. Another country that's had a major change, you're all aware of it, Argentina with Milei. The system he's put in place with RIGI, that has unlocked Argentina. Projects are starting to move ahead. The first, a smaller project, and again, probably an unknown project to most people. It's a mid-sized copper-gold project. It's in Mendoza. It's called San Jorge. I'm told by the authorities in Mendoza it is the first project that will get built under the new RIGI program. We have royalties on the gold from that asset. Another asset we've got a royalty on is Taca Taca. First Quantum is the owner of that asset, and it's probably the next big copper asset that First Quantum will build in Argentina. They will be filing their application under RIGI for Taca Taca in the coming months, and we'll start the process of moving that very big copper mine into production.
And we have probably minus 30 seconds for somebody. If they have a question from the floor, please raise your hand so a microphone can be brought forward. If not, please join me in thanking Paul for his time today.
Good. Thank you. Thanks, Paul. Brian, always a pleasure.
take this seriously, which is...
Ladies and gentlemen, good morning, and I would like to welcome you all to the session that we're going to be discussing the financing challenges as one of the challenges in any kind of industry, but in particular, I believe in the mining industry for lots of reasons that I'm sure you're aware of it, being an expert in that room. One, it's a long-term investment, and usually finance, institutions like banks or others looks for a short-term financing. And in the mining industry, we're looking for minimum 10 to 20 years, God knows, until we can get that thing from the ground and let it rolling. So that's a challenge by itself. The geopolitical issues, again, is another channel. The supply chain, again, is another challenge that facing the mining industry. However, I'm sure there is a way. If there is a will, there is a way for it, as they say. And today, with esteemed expert from all over, different industries, from the mining and also from the financing and from the banking sector, we will discuss what sort of alternative financing that could be available to support the mining industry. We're talking globally, of course. I don't have an exact number of the requirements of the money needed or fund needed globally, but figure would range from 4.2 to 5 trillion to 10 trillion US dollar. That's investment required to be deployed to get that industry going on. However, definitely from the expert, we will find about, especially the focus going to be on the SMEs, small and medium enterprises. How could we support them to raise such financing through different venues? Not necessarily the traditional financing, but again, fintech could play a role in that. Private equity could play a role in that. Also, we're going to be discussing, if we have time, what the role of the governments globally that could do to incentivize, if you will, the mining industry. Finally, if we have time, also how we could use technology today, AI and others, to make that investment easier than it used to be. And also we're going to be talking about some risk in that industry. So on your behalf, let me introduce Han Rod Phillips, Vice Chair, Concord Genuity. Han Rod, how are you, sir? Very good to have you. Also on Hegarty, Chairman, EMR Capital. Hello.
Thank you.
Nice to have you. Lungisa Vezella, who's an Executive Officer, Africa, Regions and Offshore Standard Bank Group. Hello, sir. Nice to have you. Ellen Turner, Global Head, Mining and Metal Investment Banking, National Bank Capital Markets. Hello, sir. Nice to have you, Ellen. And also Pim Glassfart, who is Hawks Point Capital. Nice to have you, sir. Also Christophe Roux, who is the Mining and Industries, UK, Africa, and Middle East Associate General. Hello, sir. Nice to have you. Let me begin with Han Rod by asking, sir, everybody knows that any industry in the world face challenges. One of these challenges is financing, creating the money that could support the investment. I think it's get a bit difficult in the mining because the geology tells us something in the ground, but once we go into the ground, we find out it's worthwhile to extract it from the ground and go into that whatever next step for. So what are the challenges facing the financing, and how could we navigate through these challenges and let it work for us, please?
So to that, thank you, and a great panel. So I look forward to hearing from my colleagues as well. First, let me say just the progress on this is going to be a function of trust and setting up the conditions where the kinds of investment that are going to be required through the various stages of development, from the earlier stage through to the production, through to where the Kingdom is very much focusing on processing. These are all different elements with different risk profiles. I have to say, one of the things that's been done quite well here in the Kingdom is setting up a regulatory framework that will give confidence to money, and a number of my colleagues will talk about the process. But one of the other things, as we talked about, I am a recovering politician, so former finance minister in the province of Ontario, and I'm proud to say that many of the regulatory and legal structures that have been set up here in the Kingdom that will provide that trust have also been modeled on the experience of some jurisdictions like Ontario in Canada, where work has been being done for a very long time, and of course that helps with the familiarity of those kinds of rules and expectations. So there's a number of features, of course, primarily the geology, the opportunity, the access to resource, the tiers of funding that are required from those junior and early stage right through to production and mid-tier, but providing that framework is going to be very important, and I think has been very well done, and will pay dividends for many, many years to come.
Now, I don't have an exact figure, but my reading says from 4.2 trillion to up to 10.5 trillion. Now, there is a story saying that the money is there, but a little bit hesitant to go and to go in. Is the money available, you think?
The money's there, but you learn this particularly in my old job as a minister. The big numbers hide a lot of detail. What I have heard over the last few days is some discussions, and there's a colleague of mine, Jeff Steiner, in the room from Canada as well, who's been working very in detail on this with specific deals and opportunities. So the money is there, but it's not there for the big thing. It's there for a series of opportunities, and those opportunities have distinct commodity realities in the world. They have distinct expertise and requirements, distinct capital requirements. Some, the fertilizer sector, heavy capital. Some much less so, depending on it. So the money is absolutely there, but the real to get from here to there is going to be about articulating specific opportunities, making sure that the money that is invested will be returned, and as you said, over a generational time frame, which is somewhat the difference in mining from other sectors.
Okay. Mr. Ahn, I'll go back to you with regard to, well, as the ex-minister said, the money is there, but the hesitation a little bit also is there. And that is priority. Being a bank, being a financing house, whatever, I have priority in my strategy where to go and where. So what do you think from your own perspective, Ahn? Mr. Ahn?
Me?
Ahn, please. Yeah.
I will. Thank you. Well, thank you, Talat. And really appreciate the opportunity to be here. Congratulations, by the way, on the Future Minerals Forum, and particularly your introduction talking about this good, strong support for the SMEs, the small and medium enterprises. Because, and again, I don't know the audience needs reminding here, but most of the discoveries and the early drill outs of ore bodies are made by the small and medium people, and that's where we need a lot of good support. So I think that's a very important background, and thank you for all of that. I think the previous speaker there talking about the great support that is being proposed here in the Kingdom, following on a lot of the support that is provided by some of the states in Canada, for example, very, very similar to the way in which the states operate in Australia. In other words, you have a good, strong, supportive background, a regulatory environment that is smooth and efficient, of course. You have support at various levels for the enterprises, whether they be the large enterprises or the smaller ones, in terms of tax breaks and various other incentives, all very good there. But the very important element in all of that is the culture, is the karma, is the attitude in terms of whether it's the national government or the state government there, in terms of a positive support for the industry. And taking your point about the multiple trillions of dollars that are required to actually produce and bring forward all of these minerals, the supply side, and we are supply side people here mainly, we have to bring them forward. It's very important to have that karma, that attitude and support that is being provided here. And we also do it in Australia, it's done in Canada, and you're starting to see it even in America now with a few executive orders there. So they're the sort of positive elements that we see.
It's interesting what you have said. So I believe what you're saying, if I understand you correctly, is the support of the government or whatever related to an institution is more important than the financing. That's my understanding.
Well, I think your government provides that strong background.
Okay.
In other words, here is the environment. Now we want you boys and girls to play competitively inside that environment. That's terribly important. See, the other thing, but there is direct involvement of government, and you see it in Australia and Canada in terms, and it's only the government that can actually provide access to ports and infrastructure. It's only the government that can do regional geological and geophysical surveys that provide the data and the information for all the private companies, small and large, to prosper. So it's important to have that, but keep it at that level.
It's interesting. We'll get to that point later on, how the government could support, such thing. Yeah. Lungisip, sir, I would like to, being a banker, and I'm ex-banker, by the way, so we speak the same language. Banks or financing now, they said, Talat, we have priority. We're not shying away in any way from the mining industry, but again, giving the risk, giving the period, the duration, whether we'll find something, we don't find something, that's a lot of risk going on. So how would you see the appetite of the financing, whether banks or non-banks, especially focusing on the SMEs? Please.
Thank you very much, and thanks to the Kingdom for having assembled all the brains that they've assembled here to provide thought leadership on some of the pressing issues that face the globe today. I mean, the history abounds that when policies are right, when the economic climate is right, when incentives are designed appropriately, financiers are able to do their sums and ensure that they play the central role that they're supposed to play across the board, financing SMMEs, financing big projects, some of them with long payback periods, as is the case with mining.
You're talking on the average 10 years?
10 years to 20 years, yes.
Okay.
They always find a way to do the intermediation that's necessary to do that. Of course, there are things that they can't do. We also know that banks, by virtue of who invests in them and the accountability frameworks in them, they find it hard to commit money longer than 10 years. But there are always ways to make sure that you find in the very same market pools of savings, different kinds, that look for long-term investments. For instance, if you think about pension funds, naturally, they look for very long-term investments. But of course, they too, they understand that pensioners look to receive their money when they leave employment, and of course, they happen to be lucky to live very long. So To your question then specifically, some of what we're talking about here as an economist, I would say, is market failure. You could say market failures of various kinds. And in fact, governments exist, I hope the minister would agree with me, to intervene to make sure that they correct for market failure. Governments the world over have created institutions to correct for market failure. As an example, they would have local development finance institutions, some specifically designed and having instruments to help SMMEs access funding of the kind they would need, even in this case of mining future minerals. They also, for instance, governments come together to establish regional institutions, international development finance institutions, again specifically to correct for some of these market failures where private money, private pools of savings don't have the appetite, given their goals, given their mandates and what have you, to put the money in those kinds of projects. And of course, what you tend to see a lot is that once governments have found the right way to correct for that market failure, private pools of funds go running in that specific area or kind of investment or asset class.
It's interesting what you have mentioned. Pension funds are really interested probably in going to the mining industry. But my understanding, pension funds are very conservative because end of the day, they're managing my money and your money when we retire. So is it priority for them if you look at the risk factor here? What do you think?
I wouldn't be telling the truth if I said it's priority for them.
Okay.
But I can say with a limited fear of contradiction that they are looking for returns. And if you present them with a proposition that presents them with the kinds of returns where they can work out that they will achieve the hurdle rates that they set themselves, they will commit.
Oh, they will commit. That's good. Sir Elian, how are you? I'll come back to you, sir. What sort of financing vehicle, instrument that would you think is more applicable? Elian, please.
Hello?
Oh, you don't have that mic?
No, I'm not one of the lucky ones.
All right.
Good morning or good afternoon. Very pleased to be here. I'd like to take a different approach than some of my fellow colleagues because I'm much more positive. We are living in a golden
We all
era.
positive, but it's an industry.
Well, my macro comment is we are living in a golden era of mining.
Okay.
I mean, right now, especially where I'm from, Toronto, which is one of the centers of global excellence vis-a-vis mining in all of its facets, whether that be mining finance, legal work, accounting, of course, the mining companies. You won't find anybody in our industry without a smile on their face. And we're not talking about lack of financing or lack of projects or lack of enthusiasm. We're talking about coming to places like Riyadh and FMF and seeing what new opportunities exist and what are the new boundaries that we can push. I've been an investment banker for over 25 years, 15 of it, the last 15 years in mining, and this is the market I've been waiting for. So I'm very positive. I think, drilling down a level, what makes Toronto in Canada so unique is the ecosystem we have. And that ecosystem starts from the funding of the most junior explorers, projects all over the world. I mean, the TSX is home to single asset companies exploring in Africa, in Asia, in the Americas. Obviously, there's windows where more money is flowing than not. Don't get me wrong, but that end of the market is what I would call the venture capital. the high risk, high reward segment of the market. So you need that. You need a segment like that. That every part of the world that wants to develop a financing ecosystem has to find those early risk takers. And for us, in our market, it's actually in the public market. It's the TSX, which is home, the TSX Venture particularly, which is there's a main market and a junior market. And the TSX Venture is where junior companies go for their initial capital, generally speaking, to start drilling and exploring and so on. And then the ecosystem, will take hold from there. We have colleagues here from Canaccord, ourselves, a National Bank, other banks that are represented here. We are financiers along the chain and very comfortably along the chain. So, as the company has success and starts defining its economic studies from resource to, let's say, preliminary economic analysis, which would be the next main level, there's another funding round and another type of investor will come in to play. And then the process will continue as the mineral inventory is defined by economic studies to the ultimate, the bankable feasibility study. And that's when the banks get involved, like ourselves,
okay.
This gentleman here, where now there's much more confidence around what is in the ground, what are the economics to get the ore out of the ground, like this gentleman here as well. And then we can start thinking about lending, or we can come to our private equity partners here and get additional sources of capital. The panelist before us, Paul Brink, runs one of the biggest streaming and royalty companies in the space. He showed he has $2 billion of readily available capital right now on his balance sheet to put to work. And I was saying to Pim, he could easily raise $2 billion in 24 hours, more probably if he wanted to. So there is lots of capital. There's lots of capital, but it's an ecosystem that works in stages and de-risks properly that gets each level of capital comfortable.
You made my life easier, honestly speaking. I'm very optimistic, but now I'm more optimistic than ever. Because what you told me, Talat, the financing is not a big chunk for a company. It's a multiple stages. So it could start from SMEs, gets bigger. So, and nice when you mentioned also the private equity role. I'll go, Pim, what do you think about the, Pim, yeah, the risk, each and every industry in the world, whatever that industry, it has some risk attached to it. But what are the core risks for going into mining?
Thank you very much. Yeah, I think talking about picking up on some of the previous points, if you allow me to...
Could you just mic a little bit?
If you allow me to comment on that, I have the same optimism, but I have a slightly different vision for the industry. We're finding ourselves in a crucial moment, and I think at this moment in time, we have an opportunity to change our funding structure. Helene is right. A lot of the early stage capital from the SMEs that we need as the lifeblood of the industry is raised on the stock exchange. And at the moment, times are good. But we all remember that that same stock exchange can be extremely fickle. And that behavior can drive certain outcomes. Not too long ago, that same stock exchange was rewarding people that were investing in crypto. And before that, it was cannabis. We're in the limelight. But let's not forget that that fickle nature hasn't changed. Now you compound that with the observation as to what pension funds do. And Owen and myself invest on behalf of such institutions. Now let me tell you the size of the prize. These institutions, last year alone, invested $700 billion in private equity funds. Mining's take of that, several hundred million. We get completely overlooked. Yet in any other industry, tech, biotech, there's a very vibrant private capital environment. And our industry should meet all the requirements. We're long-term, we're capital intensive, and we generate the returns. On paper, we're much better suited for private capital than we are for fickle public capital. I would love the opportunity, I would love the industry to change somewhat its ways, build that trust that was discussed earlier, manage the risks, and become a genuine candidate for private capital. We've seen they can do it with government capital. Now the next size of the prize is to do it such that the pension funds, the endowments, and the foundations of the world start paying attention. All stars are aligned. As an industry, we're making headlines. We're making the right headlines. The governments are paying attention. I really like us as an industry to now start behaving in a way that capital providers see we're thinking long-term, not the next quarter, genuine long-term, genuine value creation, so they come to us so that if fickle markets turn against us, we have a stable capital partner that can see us through. And we take some of that volatility out of it. So we don't need, when we're at a high, fear the lows and wait for another 20 years, but we can live in a much more stable environment. Because that's what's needed to keep building. Because we're not building for tomorrow. The numbers you quote are what is needed through to 2050. And just because we're in the sun today doesn't mean that we're going to be for the next 25 years. We need to set up the structure so that we have funding for the next decades, not the next year.
Okay. I'll come to you, Chris. Being in that industry, do you think financing is an issue?
Thank you, and thank you for being on that panel. I'm grateful to the Kingdom for this remarkable conference. I will first of all echo the comments I've heard before about the optimism. I think we are in a market now which is much more positive about mining, and part of it comes from the critical importance of minerals to many industrial trends we see across the world. The second thing is the discussion has been about equity. I would like to bring a debt perspective into that discussion. There is a large amount of capital available in the form of debt for the mining industry. I'm very optimistic about that. We've done that for decades. We've arranged ourselves, we've provided capital, we've raised capital for mining company, and I think the sector is now more positive than it was before. I would not talk about challenges, I would talk about conditions for the debt to be available. And I would probably highlight three of them, three important ones. The first one is time, because a lender will expect a mine to be properly assessed, a feasibility study to be done, an impact assessment to be thorough, and then the lenders will review all these assumptions, all these studies with external consultant. That takes time. So essentially, if you're looking at raising capital for a mine, you need to engage with professional banks at least 1 year before. That takes time. It's a process which is very rigorous, but very efficient. The second element you need is equity. And part of the constraints we have seen in the past is the difficulty for especially small mining company to raise equity in the past. Equity is needed because debt comes at the end of the chain. You finance the mine with debt when the feasibility study is ready, you have the license, everything is prepared. A lot of capital is sunk before that is feasible. And last but not least, you will not finance 100% of the capital expenditure to develop the mine. Part of it will also have to be financed with equity. And the first thing the banks will look at is a funding plan, the total funding plan, debt plus equity, sufficient to bring the mine to production to a level which is sufficient to repay the debt. So that's the second thing you need. And the third thing you may need, depending on the commodity, for some it's more important than others, is offtake. The market needs to be there. If you're talking about copper, if you're talking about iron ore, these are obviously very liquid market. It is important to validate the quality and the marketability of your product. But when you talk about very specific products, rare earths or mineral sands or battery minerals, then your production will only be produced, processed, refined by a very limited number of industries in the world, and you need to make sure before you start producing that you will be able to sell at a price which is acceptable. If you meet the three conditions, you've probably done most of the way in order to be able to raise capital from the bank.
Excellent. Going back to the SMEs, to small and medium enterprises, and I think this is the most challenge that they face. Would be angel investors will help in that? You think angel investor would help in that? Or venture capital in that regard?
I think the venture capital are essential for the development of the SMEs, but they tend to invest before the bank invests. They tend to invest to prove the resources, and the return comes from the valuation of the resources once they have been proven. We tend to invest after that when the resources are converted into reserves in order to construct the mine which will produce according to the reserve.
Oh, okay. I'll come back to you, sir. Right. Government support. Being an ex-finance minister, so when we were part of the government, what the government should do?
Well, let me just touch a piece of my last colleague's comments just first. I think what you've heard is a very good description of the chain. I think you've also heard why you need to be accessing global investment pools, and Canaccord Genuity National through the Toronto exchanges as well as the Australian exchange, because the pool of that initial risk capital is pretty unique. Just as the pools of debt capital you've heard about are also unique. And that is why I think the steps to your question about what does government need to do, primarily people who put their money in want to get their money out.
True.
And so, in the kingdom there's comfort with that, but generally around the world in different places, whether the ability to, if I make my investment, I can take that out is a critical element. The kind of structure that I talked about a regulatory structure that's familiar, and I think that's why basing it on a well-known Canadian regulatory structure is useful, that then will become familiar. That doesn't mean there won't be lawyers involved. There'll always be lawyers involved, right? But it does mean that there'll be familiarity and comfort with that. Fundamentally, of course, the geology matters, and I think it's been commented on. Only at the government level can some of that support be provided in terms of the macro geology, or can be provided. And what has also been mentioned as well, the infrastructure. I need to get my product somewhere to get paid for it. And I think the initiatives that the Kingdom are taking on refining, of course, deep expertise because of the oil and gas experience, different kind of refining, but we're talking about large-scale investments. One was announced just last night at the Canadian Embassy in terms of $100 billion project.
Yeah.
That's a very, very large project. Even in Canada, where we do oil sands, we do more expensive oil. $100 billion, that's real money. But that's a commitment to the ability to process, and then of course the other infrastructure, the roads, the rail, these sorts of things. Finally, I'll say, and I think this is a place where Saudi Arabia is increasingly playing the role, the stability of the broader region. The confidence that this is a region where we can do business and make investments, long-term examples of that on the petrochemical side. But these are all factors that will feed into those different components of capital, starting with the higher risk and moving down or up the chain, depending on where you start, with the ability to see that this is a 20 or 30-year vision. And I think the government and the Crown Prince have been clear about this being part of a longer-term vision. So those are the components. They move at different speeds. And I guess the trick for government is to facilitate those speeds so that they happen in the right order to move the ball along, as we'd say.
What about supply chain and disruption that could take place? If we go back to COVID, I hope it doesn't come back again, but again, it did a lot of pressure on supply chain disruption. Yeah. How could we deal with that?
This is where the real wisdom is required at the policymaking and government level to anticipate. But I think the comments, nothing's really new. We've seen things happen before. They say history rhymes, it doesn't repeat. And so we can anticipate the range of issues. In that situation, I think, again, Saudi Arabia, because of its geography, is positioned between major sources, not only its own domestic supply, but these are the things that the government leaders need to try to anticipate and manage over generations.
So sustainability is important.
It is essential, but remember, there's a former Prime Minister of Canada that used to say in politics, I don't have to be better than the Almighty, I just have to be better than the alternative. Similarly, when it comes to geographies, no geography is perfect. There are complexities. I speak in Canada. We've managed to take for the last 10 years some good choices. We've had changes there, but we made a very good geography a bit more difficult for people. So I think you just have to be good enough. So that the kinds of suppliers that are going to want your outputs can have confidence. And I think that's the challenge.
In my country, we believe in our government also. We believe that you turn challenges into chances and opportunities.
Yes,
absolutely. Please, go ahead.
Well, I was just going to say, really good comments there, by the way, by the minister on all of that. But coming back to and all the other speakers there, Talat, so all very good. But just coming back to the challenges. I mean, to be successful at the micro level here, it's one thing to be successful at the country level. That depends on the endowment, of course. But to be successful at the micro level, at the company level, whether you're an SME or the bigger end of town, so as to speak, you must have access to land and property and exploration ground, whether you own it or leasing it or mining license, so on. Must have that. That's a government type responsibility, but of course your own in terms of ensuring that you've got good access. You must have access to capital, and that's what we're talking about here. And the multiple instruments available comes and goes from time to time in terms of volatility, world geopolitics and so on and so forth, but you must have that access, and you must have access to people. And somebody was saying the other day, the scarcest resource in the world is not rare earth elements, it's people who know what they're doing, and you've got some really good people up here, of course, who know what they're doing and out here, but we're going to be short those people, despite AI and despite humanoid robotics and so on. We're going to be short people who know what they're doing out in the future. So we've really got to keep on our toes there. And in terms of actually to be successful at the micro end, you need to be successful here, SME and so on, you must have the deposit, you must have scale, you must have quality, so it's got to have the grade. You must have a process that is confident that you're going to work. You must have long life, low cost, lots of upside. You must have a stable and secure domain all the way from government regs through to your social license and sustaining all of that. And you must have assets or a group of assets that other people want more than you do. And that's a very good
excellent.
That's a very good signal.
Excellent.
So they're the sort of things that we focus on at the operating level and at the PE investor level.
Excellent. Back to you, Luis. What about the margins? You think what sort of margin to mitigate, if you will, associated risk?
There's a key word I've missed in your question. What sort of?
I'm talking about the margins,
Okay.
that usually, financing, whatever, imposed just to mitigate whatever the long-term risk with the mining industry.
No, look, different institutions would have or look for different margins.
Okay.
But I can tell you that for centuries, mining has delivered the goods. I mean, I come from a country that built its economy on the back of mining, South Africa. Of course, there are moments when commodity prices crash, but industry players find ways to go through those periods. Pain gets heard. Some businesses suffer losses to the point where they go under. But if you think about the bank that I come from, at the risk of sounding like a marketing standard bank, we were the bank that banked the diamond mines in Kimberley when they were first found in the 1860s. We moved to the Witwatersrand in 1886 when gold was discovered there, and the bank still exists today. Sure, we're not only banking mining, we have evolved, diversified, but the simple point I'm making is that often the market has got the ability to adjust to ensure that, to the extent possible, the right volumes of capital of the right type are attracted to the industry, such that the industry stays alive and those who support it as financiers make the money that, or the returns that they are supposed to make.
Okay.
Let me just add a point, Talat, that it's profound to me, and I hope both my fellow panelists and the colleagues in the room would find instructive. More often than not, the mistake that we make is to think that we're only solving for mining. No country is able to just develop its mining independent of everything else. In fact, the points have been made here by my neighbor already and other colleagues here. You will need the infrastructure to transport what you have. You need the power. You need to make sure that you have got water, to the extent that some of the commodities, mining processes require lots of water. You will need to make sure that today your environmental policies are correct and consistent with the commitments you might have made at the last COP and so on and so forth. So it is exceedingly important to appreciate that you are not just solving for mining. You are solving for the entire economy, the ecosystem.
It's an ecosystem.
In a way that ensures that then mining thrives.
Indeed. Okay. Ian, I'll come back to you, sir. What do you think? Especially if we want to deploy technology, AI, Internet of Things, things would be much better.
Well, I want to go back to your original question about governments, if you don't mind.
Okay.
And my short answer is just get out of the way. Let's start with that. I'm joking, but a little bit. Get out of the way a little bit. I think, obviously government has a place.
But they have the rules, they have everything.
I mean, we're talking about extraction, and at the end of the day, you can't extract something out of the ground without policy, framework, regulation. But we know when it gets cumbersome and when permitting timelines get unrealistic or too long, things slow down in the chain. And so when the market's there, but the project's not ready to accept the market or the debt, whatever, or the private equity, we have a problem. So what we've seen, for example, in the United States with the U.S. government taking positions in companies, of course, if you're on the public side of that, it's really exciting. All of a sudden you think you have this deep pocket there that just bought 10% of a company's stock, and that's a great thing. And certainly the market rewarded those companies, but in the long run, is that really what we want? Because things change, as the panelists are right to say. You know, unfortunately, despite my enthusiasm, I know this time's not different. It's a cyclical business, and so we will have, you know, we will have our down again. Same thing with the government in their investments, and when they try to offload those investments, or they try to get into the boardroom and start telling, you know, the chair or the CEO how to do things, it's not going to be pretty. So, you know, everything comes with a price. But an example where government's really good, again, to go back to, you know, our home country, Canada, is how they finance exploration. We have a construct in our country called the flow-through share.
Do they finance it 100% or?
It's called the flow-through share. I'll explain it in 1 second.
Okay.
And so a company doesn't have to be public. It can be private, but you know, the most relevant examples are public companies. They can go to the market and say, we want to spend, let's say, $5 million this year on exploration.
Okay.
And of course, they don't have any profits. These are single asset companies that are drilling for mineral resource definition. And by definition, they're going to lose money. They're not going to make money. They can pass those losses on to the investors in these flow-through shares who get a tax credit.
Oh, okay, okay.
So that's the incentive.
So that's incentive.
So you've incentivized a retail shareholder to essentially fund exploration. This is the only country in the world that has this regime. And it's a very successful regime. Now, again, it's fickle to the markets. When the risk trade is off, you know, people don't want to, you know, even though they're getting a tax credit, they're not funding exploration. But when the market's on, there's an abundance of this. And it's a very interesting tool that I don't think gets a lot of daylight, and is something, again, as we're talking about starting and defining an ecosystem. You know, and of course we've seen the Kingdom recently make a big announcement about opening up stock investment here to essentially the world. There's no regulations anymore. This could be something that the Kingdom could think about vis-a-vis funding exploration in the Kingdom.
Okay. Pim, what do you think, sir? How could we make life easier for this industry and who's working on it, in it?
The simplest thing is to keep delivering, which sounds really cheeky, but that will enable us to access those pools of capital that I spoke about earlier. To my knowledge, this is the only industry which has been shunned by genuine venture capital. Whilst we have all the hallmarks of being a very successful destination of it. And if you talk to the capital providers to venture capital, they say risk reward doesn't stack up. Too much change. People don't stick to their business plan. They're gold today, they're copper tomorrow. I don't understand. I'm out of here. Yet those same businesses provide billions of dollars of capital to biotech, technology, fintech, similar businesses in a risk return profile, businesses that have long timelines for payoffs, yet we don't get the dollars. And I'm convinced that if we start to deliver and keep flip-flopping, stop flip-flopping rather, we will be the recipient of that capital. And that ought to be a very, very happy marriage that will see us through some of these violent swings that we from time to time encounter, which in turn drive this behavior. I really can't wait to see the day where some of that changes and we have a more stable life. Because whilst we're cyclical, that doesn't mean we need to be as violent, or that cyclicality needs to be, and volatility needs to be as violent as it is today. I think some of that is self-inflicted.
Is the mining industry a cyclical business, is it?
And then some.
Really? Oh, okay. Chris, what do you think?
I think if you ask me what we expect as a bank from the government, we expect stability. We spend time thinking about volatility of commodity price, risk of cost increase, mineralogy, process, logistic, supply. that we can manage. If the government changes the rule of the game in the middle of the operation, that creates a very bad precedent for the investors.
Okay. I have like 3 minutes to close, so I give you less than half a minute if you like. Technology.
Listen, one of the other areas that we focus on at Canaccord Genuity is technology. Again, very similar. Your point about the relative realities. We don't, unlike some of my colleagues, have a balance sheet in our bank. So we're focused on the part that can't lend, and maybe we think that's why we're a little more precise on that. But technology and mining, the places it's coming from, and I'll talk specifically about China right now in terms of are different than they have been, and I think that is definitely worth noting and complex in today's environment in terms of theirs, and some of the realities. One very specifically I'll deal with, temperature, right? And to the extent that the reality of mining is a function of the temperature at which human beings can operate, is a major function of mine design, and to the extent that technology through AI and robotics is evolving, where there's less human element in the physical removal of minerals, that changes everything. So I think we're going to see an industry that is, I wouldn't say been stagnant, but consistent, evolve considerably, and particularly as it relates to the human component.
Excellent. Technology, in less than a minute, please.
We welcome technology. We finance technology. If you ask us to lend against a non-proven technology, I think it's very challenging. But we...
No, I'm not saying against not lending, but using technology, deploying it in mining industry.
We see a lot of improvement in the operation, in the net cash flow generation of company coming from geology improvement. We welcome that. But eventually, we will not take the risk that this technology works. It has to be proven technology.
Okay. Technology?
What I would say is AI broadly, and I know Pim has a comment, so I'm going to let him make his comment. But I would say AI generally is going to make mining investing, whether it's equity or debt, less risky. So whether that's AI helping define mineral inventory, vis-a-vis workers.
Do you think it's more accurate than the human?
Well, it's as good as the human building it. I mean, I guess ultimately, right? At least that's where it starts. What it learns, who knows?
Okay.
I mean, but that would be my view. Long-term, AI will help make mines less risky, which means capital should be cheaper.
Okay, Pim?
I couldn't agree more, and I'm delighted to see so many AI companies here. Cast your mind back to the first episode, and you wouldn't have seen them here. And look where we've come in 5 beautiful years. But my vision for the industry is to go the next leap and do use humanoids. I think they help for heat. But if you think about the mine design, we design a mine around keeping a human safe. That means keeping it in a comfortable temperature, keeping the air fresh. But if you take that out of it, and also take the size of a human out of it, you can design a mine completely different. It changes the paradigm altogether. What wasn't mineable before can become mineable. And our productivity will go through the roof. I have an underground blast. I empty out all the mine to keep the workers safe. Now imagine my mine is staffed with humanoids. I can blast, they'll stay there. The blast fumes don't impact them, and they're straight back to work. That's 2 hours a day, just like that.
Excellent.
I think it could be a phenomenal change to the better, and also help with some of the challenges that we have on finding quality people to operate our mines, as it lessens the dependence.
Yes, just very quickly on that, in terms of technology, there has been a revolution occurring in the industry: automation, robotics, digitisation, miniaturisation, decarbonisation, but whatever it is, we have had that revolution, so we've got it, and it will continue, and we're seeing it. The very, very good thing, wonderful thing, Talat, about AI and the data centres, they all need more copper, so we're okay with that.
The combination of technology and human beings will achieve a lot of the positives that the colleagues have talked about.
Okay, excellent. Well, I run out of time. I will take one question from here, one question from here, quick, but make it short, be specific. Any questions from here? Okay. Mike here, please. Make it short, please, if you don't mind.
The pace of technology development is accelerating so fast when we're talking about AI and robotics in mines, what is the risk appetite for taking that exposure for supporting and financing technology that doesn't have traditional verification?
Would you like to answer?
I think they're linked. It's a great question. We're talking about finance, and I think we touched on it. One of the things is Dr. Rashid is here from Columbia talking about how you actually de-risk all the elements of this through using AI to better understand the opportunities. At the fundamental basis, the reason there's that tiered investment structure we talked about is because of market failures, inefficiencies. So I think that is going to help improve mining finance to the extent that therefore the risks that understandably on the debt side and the credit side need to be assessed might become, maybe not an unproven technology, but maybe a slightly less proven technology might be viable. But it'll be the utilization of AI in the context of actual making investment decisions, understanding the 6,000 companies that exist today, and being able to disaggregate those in ways that right now are done by very, very talented humans, but with human limitations.
If you look at adaptation, there's two groups that adopt new technologies. Number one, it's the ones that without it don't have an economic deposit. You saw that with ore sorting. The people that didn't have an economic deposit without ore sorting had no choice but to be an early adopter of ore sorting. The other group is the group to whom it doesn't matter much because they are so big and diversified. Hence why the BHPs and the Rios of the world were the first to adopt autonomous trucks and things like that. If it were to have gone wrong, they could easily revert and it wouldn't have done damage. All the technologies we talk about for the future, I think you'll see the same development. The big boys will go after it because they can, and then those that need it in order to make their uneconomic deposit economic will follow suit shortly or might even be ahead of them.
Excellent. Question from the back side, this side? No? Okay, we'll take your question then. That lady over there, yeah.
Hi, thank you. So great to hear a lot of talk on small and medium enterprises, and I wanted to give a perspective and also share perhaps an idea as I lead one of those companies. 2021 started with a new team to lead a natural flake graphite developer in Quebec in Canada, and had to raise money from 2021 to this year with 5 consecutive interest rate increases on the public markets. Very, very tough. The amount of risk that a CEO has to assume to move these projects forward on a scale of 1 to 10 is a 10. Now, fast forward to today and the theme of the forum, which is how do you accelerate change? And acceleration means you can't be doing things the way you were doing them before. It takes too long. Everybody acknowledges that in Canada, for sure, in North America. So my question for all of you, or my idea, is pertaining to what our situation is. We have a grant from the United States government, from the Department of War. We have a grant from the Canadian federal government, where they are stimulating growth by paying for the studies, 50% of the studies, or 50% of the capital, and 75% from the Canadian perspective.
Okay.
We need venture capital funds to come in right beside those grants and put the money in. And I don't think that that exists right now. So if the venture capital, due diligence has been done, why not match the investments that the government is putting in? Because that is acceleration.
Excellent. I got your point. Venture capital, is it doable? I think you touched base on that thing, right?
I was using the public markets where Belinda is suggesting it's been more difficult. And again, not that markets are perfect, but markets take views on projects, right or wrong in situations. So, clearly there's market participants, broadly speaking, that have endorsed the project, as Belinda's suggesting. It's up to management and, of course, other stakeholders like bankers to explain why those stakeholders have allocated money and revisit the project, let's say.
Excellent. Before I close, I just would like to recap what has been said. I think we are very optimistic of the industry. I think no one can live without minerals. Even what we wear, what we eat, what we talk, it all needs minerals, especially nowadays with the critical minerals that's needed for semiconductor, for lots of things, that our mobile, whatever. And I think it's workable if there is a government regulation that can push things forward, and there is a lot of efforts. The Canadian, for example, that's a good example. Even in the kingdom, there's a lot of efforts, to create an ecosystem and to facilitate the mineral industry for investors. And I think it is, yes, the risk is there, but again, there is mitigants to the risk from the financing point of view. The equity funding, probably the angel investor kick in, and lots of things would happen. Thank you very much. It was an interesting panel. I hope that you enjoyed it, and I hope also you enjoyed it. Thank you very much. Thank you.
Hello? Good afternoon, ladies and gentlemen. My name is Igor Hulák. I'm a partner at Kearney, and I will be hosting this super exciting fireside chat with Mr. Farid Habib, Head of Metals and Mining at PIF. And let me, before we go to the discussion, I want to congratulate you, all of you who are in the room or who will be still coming in the room. Having an opportunity to hear it direct from someone who shapes the agenda of PIF in the mining sector is not always coming very often for anyone. The PIF, as we know, Public Investment Fund, is one of the most powerful funding engine, sovereign funding engine in the world, but we will hear more about it from Farid. But let me frame the discussion. All of us have been enjoying third day of FMF. All of us have been reading the newspapers, headlines every day. A decade ago, or half a decade ago, the mining and minerals have been referred to as something what is associated with the raw material costs. It's not the case any longer. Minerals and mining is always quoted or associated with the geopolitical agenda, leadership agenda, national resilience, national industrial development. And that's where the Vision 2030 of Saudi Arabia comes to play, and where the announcement, the much earlier announcement of Saudi Arabia that the mining is becoming a third pillar of the national economy comes to play. And PIF, as the sovereign funding engine of the national development, is a tool how to bring some of these dreams and visions to life. And we have no one less than Farid to tell us about that. So if we can open up this fireside chat by Farid, you maybe telling us a little bit more about the role of PIF in the mining development and how it fits together with the national development agenda.
Sure. Thank you, Igor. So we have a short presentation. We'll walk you through the journey of PIF in the metals and mining space.
Can we get the technical help and support, please?
Yeah. Okay. Great. So when you look at the size of Saudi Arabia and the numbers, you realize why mining has been identified as the third pillar of the economy under the Vision 2030. So when I first moved to Saudi Arabia, I did not realize how big the country is. It's two-thirds the size of India and as big as Greenland. So when you look at the map and the spread of the resources, you realize this is not a single commodity story. It's about iron ore, lithium, rare earth, phosphate, aluminium. And the estimated resources are as big as $2.5 trillion. So the role of PIF is really to develop fully integrated value chains, and we do that through our portfolio companies. So we own 64% in Ma'aden. Ma'aden is our upstream mining company solely focused on the kingdom, whereas Manara is our upstream investment company that's focused internationally. And then PIF, through its other portfolio companies, we try to fill the gaps in the midstream and downstream, and we try to develop specialty metal capabilities. So this is how we are organized. Now, starting on the upstream side, Ma'aden has significantly scaled its exploration ambition since the new strategy was approved in 2021. Since then, the company has signed several joint ventures with the likes of Barrick, Hancock, and Ivanhoe Electric. And Ma'aden is today the largest spender in exploration globally in a single jurisdiction. They're spending more than $200 million in exploration. And this has already led to some tangible results. We've discovered the 4th largest rare earth deposit in value. We've also doubled our resource in gold. So moving on to Manara. Manara, our international investment arm in mining, was established in 23. And right after, in 24, we acquired 10% of Vale Base Metals, which enables us to secure access to copper and nickel, but most importantly, access to a sizable platform that is rich in copper resource, which has the potential also to exponentially grow the production of copper, and through that we are able to secure some copper. So on the upstream side, I think the progress is solid, and there's more to come. So on this slide, we try to map out the value chains of some key metals. And as I mentioned earlier, upstream, I think we have Manara and Ma'aden. We're very comfortable in terms of the progress. However, now the opportunity and the focus really lies on developing the midstream and downstream, and this is where PIF is spending more time lately. And you may have seen the announcement yesterday. We've partnered with Shandong Innovation to develop the downstream aluminium sector. Red Sea Aluminium will be producing flat rolled product, foil, and high precision billets that will support our strategic industries. We've also signed a few months ago a joint venture with MP Materials to develop the rare earth separation in the kingdom. So I think one key message I want to leave with the audience is that we're open for partnerships with international technical partners as well as the local private sector to develop those value chains. I think the objective of this slide is really to demonstrate that by developing those value chains that we discussed earlier, the kingdom is on its way to be producing all the major components that goes into an electric vehicle. So 50 to 60% of the structure of an EV is mostly aluminium and steel. And we've used an electric vehicle, but we could have picked another sector and we could have ended to the same conclusion on that front. So just to conclude, ultimately for the kingdom to succeed in industrializing its economy, we need to build those integrated value chains. That's the only way our strategic sectors can be globally competitive, and also our ability to export and service international markets. Igor, back to you.
Thank you. Thank you, Farid, for this explanation. And this is quite clearly showing the commitment of PIF to the development of the mineral endowment of Kingdom of Saudi Arabia, but even beyond the borders of Saudi Arabia, and not only staying in mining. The mining is about enabling the downstream industries that are so important for the future economical development of the country. So let me explore a little bit more. And all of us know PIF is very active in many sectors of the industry or even human life. what are you bringing to the table when you are looking for the opportunities, and what is the competitive advantage of PIF? Can anyone be more competitive than you? You are one of the biggest in the world.
Potentially, but we try to be ahead of everyone. So I think there are three main, I think, competitive advantage of PIF is, I think, first, we're patient investors. We take long-term views on our investments. And especially in that sector, which is very cyclical, we can navigate through commodity cycles. We don't feel the pressure of having to exit an investment. So I think the second one is we have access to capital, and also our risk tolerance is higher. We can pursue large and very complex greenfield projects, which the private sector shies away from. And we can also go into invest in geographies that maybe other large mining companies try to avoid. And this is one of the theses behind Manara Minerals. We established this company with a view that with the leverage we have, with the Saudi flag, we can go into difficult geographies, invest in mining, and bring in additional supply to the market. And I think the last point is the Kingdom maintains a very good relationship with every country in the world. And a good testament of that is our partnership with Shandong Innovation, but at the same time, we also partnered with MP Material, which is a US firm. So we're perceived as a neutral jurisdiction, and this is, I think, a major competitive advantage in a polarized world.
Clear. And as you being a sovereign investment fund, yeah, we talked about the competitiveness, what the competitive advantages are, and it's always that you have a dual role. You need to find the returns for the national wealth, but you also have the developmental mandate.
Correct.
To look after the country, to develop the capabilities, to develop the talent, to develop the economy. How do you find the right way to balance these?
Yeah, obviously it's quite challenging. We don't go into an investment where we don't feel we have a competitive edge. This can be raw material access, this can be energy, etc. So we try to strike a balance between return and social economic development. Obviously, our hurdle rates are lower than a pure play private equity. Our cost of capital is lower. And then at the same time, when we look at investment opportunities, we do spend a lot of time assessing the impact of this investment on GDP contribution to the Kingdom, as well as foreign direct investment, job creation, etc.
Very good, very good. And you don't do it on your own. We know that you have a big partners, you have a big funding partners, but also one of your role is to attract the private investors, maybe even the private wealth here in the Kingdom. Mm-hmm. And frankly speaking, let me be very honest, you are one of the largest in the world. Even if I am a big local investor, I am nanomillimeter compared to you. How do you attract these private investors, partners, to go to the deals with you? Where, you know, organization size matters, different pace of decision making, risk sharing. Well, how do you address that?
Look, this is a good question. So partnership is a central part of the PIF strategy. I think part of the mandate is, you know, to also find the partners who could invest in our project. I think we play an important role, which is to de-risk projects. As I mentioned earlier, you know, some projects we go into are high-risk projects the local private sector may shy away from. So what we try to do, we come in early, we try to de-risk the projects and enable them to come a bit later potentially. And for our international partners, the key advantage is also to de-risk the investment by giving them access to our ecosystem of portfolio companies. So for example, if they come and establish a facility here, we help them secure an offtake, from our portfolio companies to de-risk the project and make it more bankable. And one important thing is that every year PIF organizes the private sector forum. And this forum, we invite international players as well as the local private sector to meet and connect with our portfolio companies so they can explore areas of collaboration, synergies, and this is how we try and foster the collaboration with the private sector. Obviously, again, it's very central to our strategy.
No, very clear that you have been in this role for some time. You have been shaping the agenda of PIF in the metals and mining and Manara at its inception. If I can say, one of the godfathers probably of that. But so you have seen the development. Yeah. And let me stay a little bit on this partnership with the private investors. So attending the PIF forum is one, but you have seen what worked, what maybe didn't work. So if I am one of these smaller type of investors and want to work with you, do you have any good advice for me what I should change to become your co-investor partner?
There's no specific criteria. I mean, we look at the private sector either for their technical capabilities or access to capital, etc. So there's no specific criteria, but I think the advice is please reach out to us, either through this conference, through the private sector forum, or differently, but we're really open for collaboration with the private sector, and we are actually encourage them to participate in our projects. As you've seen the value chains, there's a lot of work to be done. We cannot do it on our own. So we very much encourage the private sector to come and participate with us.
So what I'm hearing, Farid, the message to the private sector is don't be shy, reach out. You know, correct. You don't bite, you co-invest. Yeah. That is a clear message. I'm afraid that probably we will have a few more minutes, and then we will be asked to vacate the room for others. But also, let me use the opportunity, and also for the audience. And I know that you cannot speak about all your transactions that maybe they haven't been announced yet. But when you look behind, yeah, the journey, what are the 2 or 3 or 1 transaction that you are most proud of, that probably you will remember when you will retire?
I think I'm proud of every transaction. I think we did a good job on Ma'aden. If, you know, in 2021, this was a struggling business, highly levered. We managed to turn it around. We set up the strategy in 21, as I mentioned, and today it's top 10 mining company by market cap. Manara Minerals, I think we set up this company from scratch. We built the management team. Within a short period of time, we did our first transaction. I think Manara Minerals and Ma'aden created momentum for this conference. And to be honest, I'm actually more excited of what's ahead. As I mentioned, we're really committed to building those value chains. So, you know, in 5 years' time, I hope that everything we showed will be realized. And out of this, I mean, you may see the emergence of a new national champion in downstream specialty metals, which I think hopefully young Saudis would be proud to work for.
Let me take your word for that. I made a private deal with the organizers because, well, we know this is recorded. So maybe my last question to you is, and they will play it at the point of the 10th Jubilee edition of FMF, what we have just discussed now here. So if we fast forward 10 Jubilee of FMF, 2031, and in the audience, the young Saudi engineer will be sitting, or one of your big funding co-investor will be sitting, and they will be asking the questions from the audience, and they will ask, what are you most proud of, what you changed in the mineral industry? what you want to be remembered for? What your answer in 2026 would be that we will watch in 2031?
I mean, to be honest, I would like to see Saudi-made metal going into Airbus and Boeing aircrafts, as an example, or any other electric vehicle. I think this is what we would be most proud of, to be honest.
Well, ladies and gentlemen, this is an ambition to finish off. I think to go, we will remember Farid, so to go on holiday, and when we fly to those destinations where we want to spend the quiet time with our loved ones, maybe the wing that will be carrying us will have a little bit of Saudi aluminium. So that is the ambition. A little bit is not small, it's a huge ambition. No, thank you very much for listening to this fireside chat. Maybe we have 1 minute for the questions from the audience. Sure. Shall we ask the audience whether you want to use the opportunity of having the men from one of the largest sovereign wealth funds on the stage to ask any questions, if anybody would like to ask? Personally, I don't know ask more after hearing this ambition of having Airbus or Boeing carried by the Saudi metal. But if we don't have any questions, let me thank Farid very much for sharing this exciting story and the journey so far, but more importantly also what is ahead. And as a message to the private sector and private co-investors, please feel free to reach out. They don't bite, they co-invest. Yeah, thank you very much.
Thank you.
Hello, good afternoon. Please take your seats. We're about to get the next session underway. I'm Paul Harris. I'm the Americas editor at Mining Journal, and I'm also the senior mining editor and anchor at Kitco Mining. We're covering a wide range of minerals in this session, all critical in their own way, and we're hearing from some of the companies looking to bring new sources of them to the market. We're going to start off in Peru, and I've got the great pleasure to introduce Guy Goulet, Chief Executive Officer of Cerro de Pasco Resources. Guy, over to you, please.
Thank you. Well, thank you for attending. I invite you to sit down. I promise you a good story here. So what you see here is the community of Cerro de Pasco. 67,000 people living there at 4,400 meters above sea level in the Andes of Peru. It's a community, but as you can see, it's also a mine. Has been discovered by the Spanish back in 1630. They start an operation there. That mine has never stopped its operation since. Rare are the mines that have such a statistic. In 1906, Mr. J.P. Morgan himself made what they still call the greatest investment of the 20th century in Peru. He invested tens of millions of dollars into that project, which is today equivalent of billions of dollars. Americans have sent to Peru the best engineers, the best geologists, the best metallurgists, the best equipment. Cerro de Pasco became the school of all the mine on the planet. Cerro de Pasco became the cash cow of the country. Cerro de Pasco became the largest gold, copper, silver mine in the world. So they extracted from that pit over the years 300 million tons. Some of it was processed, 75 million tons, and the rest of it was stockpiled. 104 million tons. So next slide, I'm going to show you a satellite picture. So here's the stockpile, 104 million tons, and here are these tailings. So what we own, Cerro de Pasco Resources shareholders, we own the mineral rights on these stockpiles and these tailings. So we own the mineral rights on what we expect to be the largest above-ground mineral resource on the planet. The pit has been shut down some 10 years ago. There's an operation run by Volcan. Those two flotation facilities are still in operation, 10,000 tons per day. Well, since the pit at the time, Volcan, who's a large zinc producer in South America, was owned at 80% by Glencore. They shut down that pit. So since that pit has been shut down, well, there's no more offtake, so no more interest for Glencore. So at some point in 2019, 2020, Glencore wanted to get rid of the mine and those flotation facilities. So we were, in fact, the only potential buyer. Why? Because we got the resource to run those two facilities for 25 years. So what we did an intense due diligence. We sent 2 engineers, 2 metallurgists on site, and we compile everything that had been processed from 1906, when Mr. J.P. Morgan made the investment, until 1992, when they stopped dumping material in these tailings and they start dumping material in a modern facility. So we did that compilation. We end up not making a deal with Volcan Glencore. Why? Because we were going to sign that deal in March 2020. What happened in March 2020? COVID. So we end up not making a deal. But we did that compilation. And that compilation, we know precisely what they have processed. They have processed 75 million tons. The grades were exceptional. The recovery was poor. Why the recovery was so poor? When you do flotation, you rapidly recover 60% of your metals in the first 24 hours. And then your curve goes like that. So what? They were stopping there, and they were throwing that rich material in these tailings. This is why the Quilacocha tailings that we own are the richest tailings on the planet. Even the average grade here is higher than the average of underground mines on the planet. So with that compilation, we can also estimate the contained metals. We did that 4 months ago with silver at $30. So if you put the copper, the lead, the zinc, the gold into silver equivalent, you end up at 423 million ounces of silver equivalent. It's $15 billion worth of metals above ground. Just in these tailings, we probably have as much in the stockpiles. So let's recall today, to produce base metal and precious metal, 40% of the cost average is mining. There's no mining here. So that's the value distribution. If you take last night price of metals, probably coming close to be a silver mine. So we do have a very good relation with the community. All the number from the compilation, we have to prove that, we have to drill that. So we drilled that lately. We performed 40 holes campaign. And while we're doing that inauguration, this is the Presidente, the mayor of the community. He mentioned to everybody, he says, we all would like to have our children to go to school, to college and university in Lima. We just don't have the money anymore since the pit is shut down. That mine used to employ 7,000 people. Today, that mine barely employs 400 people. You understand, we're welcome to Cerro de Pasco to create wealth again in the community. So we performed that first drilling campaign. So we start with an impact drill, and we end up with a sonic drill because these tailing has been deposited in a lake, in former lake. And in the middle, it's 50 meters deep. So we take sample like that, 1 meter by 1 meter. We isolate them, we freeze them, and we send that to the lab. And when they come to the lab, we split the sample in two. Half of it went for assay, the other half we're doing metallurgy. So why we're freezing them? Because we're not doing metallurgy right away. So we don't want the material to oxidize because it's 50% pyrite. If you leave the material there for a month, it's going to be all oxidized. So we want to have the material as it was in situ. So we performed those first 40 holes, and after 40 holes, we are exactly where we expected to be from the compilation, except we're a little low on copper. Why is that? Because copper is here. Copper has not been drilled yet. That zone comes from the underground operation from the beginning of the 21st century, where they were really targeting copper, silver, gold veins. They were processing and they were dumping here. So we will drill in few months this area, and this number will become 0.43% copper. The one thing we didn't know we had, and this is why we're here, we have a lot of gallium and a lot of indium. And you check those metals, silver, zinc, lead, copper, gallium and indium. Those 6 metals has just been added to the U.S. critical mineral list. We believe we host the largest known above-ground gallium deposit on the planet. I don't know if you know about gallium a little bit. Gallium chips are to replace the silicone chips. They're way more efficient to absorb higher frequencies, higher voltage, higher temperature. 98% of the gallium is produced by China. U.S. desperately need gallium for satellites, radars, built jet fighters, F-35. United States have no gallium. So we found that. Pentagon's really concerned. We found that on mining.com. Recovery of gallium from existing waste stream is the fastest way to make the material more available, including efforts that reprocess mine tailings. This is us. This is precisely us. So we communicate with the U.S. Embassy in Lima. So let's see. We might pull a rabbit out of the hat in a few weeks. You know what happened when the government of the United States invests in a junior mining company? Stocks flies. Please keep an eye on that. What's the problem in the mining business today? The answer is mining. Mining is expensive. Underground mining, you have to pump air, you have to pump water out, you have to pump air down, loose block, engineering, drilling underground. I had 4 underground mine. People calling me at 2 o'clock in the morning, Guy, the pump is bust. The mine's getting flooded. What do we do? That's the beauty of the project. Mining costs $1 per ton. Plus, underground mining, you get dilution. You get that vein. 30-gram gold. Mine it now. Going like that. And it's abolished the time where you send little children mining that. It does not exist anywhere in the world. Today you mine, you got to bring a scoop in. It's 2 meters minimum. Here, all the numbers I've shown to you, 0 dilution. It's what's going to be sent to the mill. It's the head grade. That's the beauty of that project. So are we going to make money out of this project? We will do a very rapid exercise, and we will use silver at $30 instead of 87 as it is today. We'll use gold at 2,500 instead of 4,500, and copper at 9,000 instead of 13,000. And we say we use the neighbor facilities, which have old Denver cells, 70 years old. They did some tests already on our tailings. They recovered 41.5% of the metals. So let's say we're miserable and we recover 40% of the metals. We still make $151 million profit a year for 21 years with silver at $30. So now we're going to do another exercise where we're less miserable. We're going to build our own plant. And we're going to take still silver at 30, gold at 25, copper at 9,000. And with a modern facility, we're going to recover gallium and indium at very conservative price. So now with the modern facility, 40%, we're going to be easily north of 70%. With this recovery, we end up at $650 million profit a year for 11 years at 20,000 tons per day. Now let's do another exercise. We're going to use silver at 50, gold at 4, and copper at 10. If we're miserable on recovery, we make $200 million profit a year for 22 years. If we're good, $842 million over 8 years. So you want me to do the exercise with last night price of metals? This number come to 1.3 billion a year on 11 years. Our market cap is 350 million Canadian. We should be trading at $2 billion in the near future. So what's left to do? Catalyst for 2026. So we have drilled this area. So now we're going to annex what belongs to the government to our permit. So that's what we're doing. We're formalizing claim on surrounding ground. So now we have to assume the treatment of the acid water here. There's an acid water treatment plant there. It's going to cost us $1.2 million per year. We have a lot of cash. We have $40 million cash. So when we have formalized claims on surrounding tailings, we're going to drill the rest of the tailings. In the meantime, we're doing a lot of metallurgical tests. We're getting better. Every week we're getting better. In March, we're going to publish some results. But in the meantime, we have started a feasibility study. There will be no pre-economic assessment study on this one. It's a mine. So even if we finish the pre-economic assessment study, the feasibility study will come 2 months later. So better start the feasibility right now. So the feasibility will last 2026, and in Q1 2027, we're going to apply for an exploitation permit. This is how we're going to process these tailings. So these are the tailings. They're saturated with water. Okay. So if you do an excavation like this one, it's going to be naturally filled with water. We're going to bring a pontoon on site, and we're going to sink those slurry pumps. And we're going to smoothly pump this to start to the neighbor facilities that belongs to Volcan, and eventually to the facility we're going to build. You see, we're producing some slurry like that, and we're smoothly pumping that day and night to the neighbor facilities. Let's recall, that mine was operated very aggressively by the Peruvians historically. It was a machine to print cash. There was 24-hour-a-day dynamite, trucking, dust, noise. We're eliminating all that, and this will be Cerro de Pasco in the emblematic Cerro de Pasco in 25 years. So that's how we do. We shareholders, we've got Uncle Eric. You probably know Eric Sprott owned 20% of the shares of the company. And with management and 4 institutions, like the 6 of us, we own 40% of the shares. We have 600 million shares outstanding with a market cap of 350 million. So we had some resistance here at 50 cents before Christmas. Why is there? It's because we issued some warrants. It took us a long time to get the permitting. So we issued some warrants, and there were some warrants at 15 and 25 cents. So just before Christmas, people sell the shares to exercise the warrants. Like the warrants at 15 cents, the shares were trading at 60 cents. People that own 100,000 warrants, it's $45,000 if you sell the share and exercise the warrants. $45,000 just before Christmas. It's good to bring the family to Orlando. So anyway, the good thing now is most of the warrants here are in the back pocket of Eric Sprott. And Eric does not need to sell shares to exercise warrants. So we're flying now. We're flying now. Stock was trading at 58, 60 cents. Now we're flying. This is us.
Well, thank you, Guy. Got a few follow-up questions. We have a few minutes. Please take a seat. So in terms of the processing, initially you'll use the Volcan plant, then you're going to build your own plant to do that. Is there any permitting necessary for you to build your own plant? And if so, what's the sort of timeline and process there?
Okay, so yes, there's one permit required. It's an exploitation permit. But we cannot request it until we finish the feasibility study. So we'll come to the government in Q1 2027, and we will say, here's the NPV of that project. By the way, we're going to give you 30% income tax on that. There's no NSR. So yes, there's an exploitation permit, but we cannot apply for it until we finish the feasibility study.
Okay. With the Volcan plant, the flotation plant, I think you said the recovery there isn't as efficient as it could be. So how will the plant you plan to build, how will that be different to the Volcan plant?
So, well, you see Volcan, the pit is shut down. They're still active with those 2 flotation facilities. They process 10,000 tons per day still. They're reprocessing their low-grade stockpile. 1% zinc, less than 1 ounce silver. They make money because the price of metals are so good lately. Okay. But at some point, their stockpile will be done. So we've got 25 years of resource. So what we're going to do, we're going to make an investment probably of $50 million to change those old Denver cells and replace them by Jameson cells or Metso cells. CapEx, $50 million. Next question you're going to ask, how much it's going to cost to build our own plant? It depends if we use Chinese equipment or German equipment. Let's assume we use German equipment. It's going to be just north of $300 million. But the payback is within a year.
Okay, and what will that do to the recovery? I think you said the existing plant is, what, 60% recovery? So what will that do to the recovery?
So the 60% was because the time of flotation was too short, okay? So with new flotation facilities, we might be just north of 70%, okay? We're studying, we're investing $400,000 US per month in metallurgy in other tests. Gallium is not easy, by the way. Gallium can be with the aluminum silicate or can be with the zinc. We see it with the topaz right now. Gallium, it's tricky. So we're doing a lot of tests right now. We assume we're going to be north of 70%. So north of 70%, you see the results here. With those price of metals, such a unique project.
You've anticipated my next question. Gallium and indium, are there separate processes or additional processes to be able to separate those out?
You know what? I don't have the answer yet. We're working on that.
So the metallurgical studies?
Yeah,
okay.
yeah. So if it's in the silicates, it's a little more complicated. If it goes with the zinc, it's better. We're studying that right now.
Okay. For what you're saying, a tremendous opportunity. What are the key things that you need to do to exercise that business plan and deliver on that business plan?
So we need to get the easement, annex the rest of the permit, number one. Number two, we need to succeed with the metallurgy. And, well, I'm going to answer other way, okay? Ask me what can go wrong. You see what can go wrong. So generally, junior mining company, you can run out of money. So we got Eric Sprott there. Okay, Eric is a multi-billionaire. He's involved in so many junior mining companies. He's doing so well lately. So it's going to be very difficult to run out of money. Plus, with all those concentrate coming, there will be off-taker like Trafigura, Glencore, IXM. There will be a lot of off-takers. So we should not run out of money. What can go wrong? We've got problem with the communities. You saw what I present to you. Community want to start this as soon as possible. Number three, and this is the key thing, what can go wrong? Metallurgy. So we're doing well right now. Even at 40%, we make money, but we don't, like, we're miserable if we do 40%. So we're going towards 70%. These are the main milestones.
And for the metallurgical testing you're doing, when do you anticipate having the results to that?
So we have results right now. We're not publishing them because every week we're doing better. We're doing better. We're doing better. We're trying something. Oh, some weeks we're going, no, it didn't work. But generally, week by week. So if we announce something today, people will say, that's it. That's what they can recover. But it's not like magical sticks. Metallurgy, you got to test. We're doing 2 tests a day. So probably we have a clear flow sheet in March 2000, in March this month, in 2 months.
Okay, very good. Now, once you've excavated and pumped out the existing tailings, you put them through your process plant, where do you deposit your tailings or the tailings from that, your process?
So ideal would be to make a deal with Volcan, throw this back in the pit. The pit, like there's still 1 billion ounce of silver equivalent in that pit. You cannot, it cannot go into production anymore because the houses are too close. That mine first was, that city was built, they sink a shaft, and beginning of the 20th century, you put the GM house beside the shaft, you put the cafeteria, you put the clinic, you put the school, the church, you grow the city around the shaft. And suddenly, they realized in the 50s, whoa, we're seated in the mine. So they had to push all those houses. But now, the way it's done, you got to respect such a strip ratio. And in 2026, you check that house, you're going to pay $5,000 for it. Move the family, it's going to cost you $250,000 with NGOs and everything. So you cannot go back in that pit. So to answer your question, ideally, we're going to throw the material back in the pit. Okay. One, or we've got 6 other potential locations. Now, all around belongs to the community of Cerro de Pasco. And that community wants us to start the project that have so many winning conditions. Create wealth in the community. We're going to clean up the area. We're going to give a big check to the government of Peru. We're going to profit, a lot of profit to the shareholders. Like, this project has so many winning conditions.
Thank you, Guy. Now, a lot going on, so what would you tell our audience? What are the key catalysts they can expect to see from you this year?
Metallurgy. That's it, metallurgy. Like the Formalization of the claim surrounding the permit, it's a formality. Metallurgy is the key. Financing will not be a problem. Even people in Europe tell me, keep us some offtake. He says, the day you're going to publish that feasibility study, there will be an NPV there. You open the door of your office this morning, there will be a lineup of off-takers there.
Okay, and the feasibility study, when will that be delivered?
2026. End of 2026, we should be finished. If we delay, it's going to be Q1 2027. This is where we're going to apply for exploitation permit.
And how long does it take to process that exploitation permit?
So Peru takes long. So they will have some observation. It's going to take 6 to 8 months, okay? And then we're going to decide, we're starting with the neighbor facilities. So then we have to change the flotation cell, just the inside circuit. This will take 6 months. So Q1 2028, we should be able to process some material there. For our own plant, it's going to be Q1, Q2 2029, which is very close, by the way. You start a mine today, you finish the feasibility study, you're going to be in production in 10, 12 years. So we're talking here 2 years. It's very, very short.
Okay, excellent. Well, I wish you the best luck with that. Guy Goulet, thank you very much for joining us this afternoon.
Thank you.
Okay, next up we have Jose Palma, Executive Vice President of Aclara Resources. Just wait a couple of moments while he makes his way to the stage. Now, Aclara is one of the most exciting companies in the critical minerals space. It's building out an entire supply chain in the critical minerals, rare earth elements. I had the pleasure and privilege to visit the facility. This is the Carina test plant in Brazil. I visited that last summer. Without any further ado, over to you, Jose. Thank you.
Thank you very much. I'd rather stand if you don't mind. How are you? Well, hello everyone, and thanks for coming. I know it's a long week of meetings, so let me get rid of my cell phone because I think it's messing up the communication. So briefly, what makes us different from everybody else? We believe we have 3 key factors that differentiate us. First of all, we have 2 world-class ionic clay deposits in 2 mining-friendly jurisdictions, Chile and Brazil. Both of them, I must say, are very heavy on heavy rare earths, which as we'll talk about more, is really critical for the energy transition and for all the high-tech applications that the world needs. Second of all, we have a very clear strategy to integrate vertically, and we are already in the process of implementing it. For that, we have strategic alliances, both with one of our shareholders, CAP, as well as with the U.S. government, which I'll talk some more about. And finally, we're backed by very strong shareholders. We have 3 anchor investors that view this as a long-term play. Even though we may have the market cap of a junior mining company, even though we are listed in a traditionally, junior mining space such as the TSX, we are long-term players. Our shareholders, the Hochschild Group, has been around for over 100 years. It's an industrial mining group with operations throughout Latin America. CAP has been around for 70 years. It's the 5th largest iron ore producer in the world, involved in steel manufacturing. They also view this as a long-term play. So that makes us different. We're here to stay. We're here to build a new industry. And we truly believe that that's a competitive advantages with those 3 large anchor investors. Talking a little bit about dysprosium and terbium, the 2 heavy rare earths that really underpin our business model. We will be producing lots of light rare earths and other like yttrium, samarium, etc. But just focusing on DYTB for now, and I'm sure you've seen something like this before. This is a projection of the demand. Just on DYTB in 2024, as you can see, the production was around 3,000 tons. and it is expected to jump up to 5,800. This is only with electric vehicles, by the way. It doesn't take into account robotics. It doesn't take into account many of the other applications that we are now seeing. So we expect the gap to even increase more when you take that into account. And to the right, as you'll see, while important, we will produce a fraction of what the world will require. So our Carina project will produce 175 tons a year of DYTB, and our Penco project in Chile will produce about 50 tons. So all in all, about 99% of the 2030 expected 2030 supply gap. That means that there's room for many other players. I mean, the gap is so big that you know, the world is going to require these materials. Talking a little bit about our vertical integration. Simplifying, you know, four steps to get to the permanent magnet. You have the mining, which we're doing or will be doing in Brazil and Chile. You have the separation, which we are already implementing in the United States. And I'll talk more about that, but basically we are installing a pilot plant to do separation of heavy and light rare earths in collaboration with Virginia Tech University in Blacksburg, Virginia, and we have already selected the site where we will establish our industrial separation plant in the state of Louisiana. On the metals and alloys front, like I said, CAP, which is one of our shareholders, the third largest shareholder, and also our joint venture partner in Chile. They own 20% of our Chilean subsidiary. They have 70 years of experience in steel manufacturing and alloy manufacturing. So combining their experience with the new technologies and the experience that Aclara brings, we have a 50-50 joint venture where we're making great progress in terms of metallization. And finally, we have a strategic alliance with one of the premier magnet makers in the world, Vacuum Schmelzer. It's a German company, already operating in Germany, and also just recently inaugurated their new manufacturing facility in the United States, in the state of South Carolina, that was built with a grant from the Department of Defense back in 4 or 5 years ago. So what will we be offering that is different from China? We will have a reliable source of DYTB available. We will be able to enter into long-term contracts. We will offer traceability, observable transactions. We are and will be complying with environmental, social standards, and we are going to be geopolitically independent from China, which is, as you all know, the country that holds a almost quasi-monopoly on these type of materials. Who are our customers? Long-term customers are the OEMs, the GMs, the Stellantis, the Teslas of the world. Again, only focusing on EVs. This doesn't take into account robotics and other applications. So this is a key slide for us. I don't know what happened to that picture, but this is at the heart of what we do. I mean, we have developed in-house a very friendly, environmentally friendly processing system. We designed it, and it was validated by the University of Toronto. We actually patented it. We call it the circular mineral harvesting process. And what it does is it allows us in a closed circuit to extract through ionic exchange the rare earths from the ionic clays using a simple fertilizing, which is ammonium sulfide. But the beauty of the process is that we can recover 98% of that ammonium sulfide, lowering our OPEX, but also being environmentally friendly. We will recycle through a water treatment plant 95% of the water that we will be using in the process, so we'll have very little. In fact, in Chile, we won't use any fresh water. It'll be completely 100% recycled. In Brazil, it will be 95% only fresh water. It won't have any tailings dams. We don't have any water discharges because the clays are shallow deposit. The ionic clay deposits are shallow. We don't use explosives. we don't grind, we don't mill, therefore we don't change the physical properties of the clays, and because we only use ammonium sulfide, like I said, a common fertilizer, we also don't change the chemistry of the clays. Therefore, after washing them with the same water that we've recycled permanently, we can use those clays to rehabilitate the areas where the clays have been extracted from and replant the native vegetation. With the process, we're able to produce a very pure carbonate. We've reached 96% purity of the 17 elements, that constitute the rare earths. The picture to the right is a small picture of the carbonate that we produce. That actually is our plant in Chile. We initially tested our process in Chile for close to a year. We then exported that plant to Brazil. It's installed in Brazil in the state of Goiás. We've run a piloting about 5 months, and we're going to do another batch starting in March to continue testing, to continue perfecting the system with the clays from our Carina deposit. Oops, sorry. There we go. Talking a little bit more about Carina project in Brazil. It's located in the state of Goiás. The state of Goiás is a very mining friendly, I would say, friendly towards private sector in general, but specifically mining-friendly jurisdiction. Picture on the left is we're there with the governor of the state and his top secretaries. We signed an MOU where the state agrees to prioritize our project as a strategic project of relevance for the state. Important to note that Goiás is the only state in Brazil that already has a rare earth producing mine, Serra Verde. So they're familiar with ionic clays, they're familiar with rare earths, and they have already authorized a project which is currently already in operations. So talking about Carina, estimated life of mine of 18 years. Like I said, only of DYTB, about 175 tons. Of light rares, we're going to be producing close to 1,200 tons per year. Development status, we're in the feasibility stage. Our PFS was published in October of last year, complying with 43101 standards. We expect the feasibility to be completed by the end of April. So we're really fast-tracking the project, using a lot of the work done in Chile over the last few years, which has allowed us to really make great strides in terms of the metallurgical process. The CapEx estimated is $680 million. Most of it goes to the plant, I would say about 635 to the plant, including the transmission line that we will be building, and the rest for the initial mine development. Start of operations is scheduled for mid-2028. We're in the environmental licensing phase right now. We believe we're in the final stages and probably will be completed in the second quarter of this year. That will allow us to start what we call early works second half of this year, building the access road, building the camp where the workers will be housed, so that when full construction begins, once we get our construction permit, which we expect it to be in December or January of next year, we can start right after the rainy season to begin full construction of the project and have it up and running by the third quarter of 2028. The U.S. government is backing this project. The United States Development Finance Corporation gave us a $5 million, I'm going to call it a grant, financing, to help us precisely take the project from pre-feasibility to feasibility. What's interesting about that particular instrument is that it basically gives the U.S. government through the DFC the right of first option to continue to invest in the project, and we are hopeful and we expect them to do so. We also have developed local partnerships. It's very important, to also develop a network and ecosystem of critical stakeholders. And so we're working very closely with the State University of Goiás on developing R&D regarding rare earths. We're working with Magabras, which is a permanent market pilot plant in the state of Minas Gerais. And we have been chosen by FINEP, which is let's say a sub-program or a program of BNDES to also potentially receive some financing for additional R&D in Brazil. So working very closely with the local stakeholders to generate value for the country. Oops, sorry, I'm going backwards. All right, the Penco module. This is our project in Chile. This one started first, actually. Life of mine expected to be 14 years. It's a smaller project, as you can see. We'll only be producing about 50 tons per year of DYTB. It has higher grades, but it's a smaller mine. Development status, very similar. We're in the feasibility stage. We're also on the final stages of permitting. We expect the permitting to be granted second quarter. We've tried very fast, to do it this quarter, but unfortunately, with the change of government, it's most likely going to happen with the new administration of President Kast. Start of operations also mid 2028. It's a project that, because of its size, can be built much quicker. And it's also, I would say, a quasi-urban project. It's close to the city of Concepcion, so the infrastructure is absolutely excellent. I already talked about the permitting. Our partner CAP, who I mentioned, owns 20% of this company. And they have the right to increase their participation from 20 to 40% once the permit is granted and once we sign an offtake agreement, by investing another $50 million. So as you can see, this project, the development of this project, I would say, is more advanced in terms of the financing, because with a $50 million capex injection from CAP for a project that has a capex of 130, you only need to finance the balance, which is perfectly doable either through the capital markets or through bank financing. Separation, like I said, we chose the United States to do the separation. Why? Because this is a race. This is a race against China. This is a race to develop the independent supply chain, and we believe the fastest way to do it is right now in the United States. It offers us a whole bunch of advantages that we have identified. Number one, it offers us the technology. We're working with Virginia Tech. We're working with Argonne National Laboratories to create the process necessary to do separation of heavy rare earths in the United States. We're using artificial intelligence to do a digital twin. We're doing that with Argonne National Laboratories, which is an arm of the Department of Energy. And we're going to be inaugurating this pilot plant at the end of March. And we'll be separating at least 5 rare earth elements and producing oxides with them, obviously at a pilot stage. That technology will then be industrialized and, to an industrial scale in the state of Louisiana. Why did we pick Louisiana? We did a very extensive location study looking at different states. Ultimately, we picked Louisiana because it offered us a series of advantages. Number one, it's a strategic location, very close to a waterway access to the key reagents that we will need. To do separation, you need a soda caustic, caustic soda. So you need to be close to industrial sites that provide you that caustic soda. Westlake, for example, one of the largest chemical companies in the United States, only about 20 miles away from our project. So we can get what we need from them very cheaply in a very friendly fashion through the waterways. With skilled workforce, the size of the lot that we've secured is big enough to house not only the separation facility, but also the metallization facility. Very importantly, the state is 100% pro-business. They've granted us $46.4 million in tax credits and in grants in order for us to put this facility in the state of Louisiana. And also key towards achieving this very quickly is that the site is already what they're called lead certified, which means that it has been pre-authorized and has some of the initial permits so that we can fast track the permitting and be ready to start constructing at the end of December of this year. In fact, this separation plant is going to be ready before the mines are entered into operation. We expect that this will be completed in 2027, and like I said, the mines will start operating in 2028. Metals and alloys, like I mentioned, we're piggybacking on a lot of the knowledge of our partner and shareholder CAP. As you can see on the right-hand side, we're already doing tests. We've gone throughout the world. We've been in Vietnam, Germany, everywhere you can think of, testing different technologies, applying them to the system, and we've picked one, and now we're also in the engineering phase. We're working on all these, both the separation and the metallization with Hatch, which, as you know, is a big engineering house from Canada, but it was the worldwide footprint. And we're making great progress, and also expect that to be ready around the same time in 2028. The capex for this is $130 million. Again, I'm going backwards. So, like I mentioned throughout the presentation, we believe we have developed key strategic relationships that will make our story a success. We're backed by very strong shareholders, Eduardo Hochschild personally, the chairman of the Hochschild Group, Hochschild Mining itself, which started this process in 2018, but has kept an interest in the company of 20%, and then CAP, who has 10%, but can actually increase, according to their investment contract, up to 19.9% of the shares of the company. So we have very strong shareholders who believe in the story, who have the financial wherewithal to continue to support it and back it. So running out of money in this context is a remote possibility. Government support, the government of Goiás is fully behind us. I would say that the federal government of Brazil as well, they view rare earths as one of the key strategic advantages of Brazil, and they're promoting not only us, but Meteoric and Veridis and Serra Verde and all the other rare earth companies that are actively pursuing the implementation of rare earth projects in Brazil. The USDFC, like I said, has invested in us $5 million, and we believe they will continue to support the project. And the Louisiana government has also really thrown all of their institutional support behind the project to make this a reality and get it done as soon as possible. Other key partnerships, Vacuum Schmelzer, like I said, one of the leading permanent manufacturers in the world. With them, the beauty of it is that, you know, they're telling us what it is that they will need from us once we operate. So in a way, we're doing some reverse engineering. They're giving us their specifications of what they'll need to do the permanent magnets, and we're reverse engineering all the way to the mine so that we can deliver them the product that they need. Vacuum Schmelzer already works with GM, already works with the Defense Department, already works with some of the key OEMs around the world. Virginia Tech, we also view them as a strategic partner. They're providing, we're doing the separation with them. Stanford University, I didn't talk about this, but we also have an agreement with Stanford University to use artificial intelligence to develop techniques to improve and fast-track exploration of heavy rare earths. And like I said, financial market, that's outdated. Fortunately, it's not it's US 400, so it's fine. We're about $600 million Canadian, so roughly $450 million US. To date, we've invested $240 million. Like I said, it is going to take another $1.4 billion to get all 4 of these projects done. We believe that it is absolutely doable. This year, we'll probably be raising anywhere between $100 to $200 million to advance these projects to meet this deadline, self-imposed deadline of 2028. Sorry again, going backwards. And to conclude, we believe that we are one of the strongest companies out there in terms of positioning to be a market leader, to be able to provide independent, sustainable, resilient, heavy rares to the U.S. market and to the global markets. Thank you very much.
Excellent. Thank you, Jose. Please take your seat.
Sure.
Now, Clara, it is a very impressive company. You've achieved an incredible amount in a relatively short space of time, so congratulations there.
Thank you.
The trajectory you're on is quite impressive as well. Quite ambitious, obviously, trying to put in place a whole supply chain. Most mineral developers are just happy digging stuff out of the ground. I want to go, despite all the sort of technology and the supply chain aspects you're putting in place, I want to go right back to the start, to the ionic clays. Most of the companies looking to develop rare earth elements, to produce rare earth elements, they're looking at hard rock deposits, carbonatites, alkaline igneous rocks. Ionic clays give you certain advantages over that kind of geology. Maybe we can start our conversation by going into some of the advantages of ionic clays versus hard rock.
Sure, and it's a great question, and I talked a little bit about this at the last panel. I mean, the beauty about the ionic clays is that the nature has done the work for us for over millions of years through a process known as weathering. So basically what weathering means, to explain it very simply, is that the rock, the underlying rock, has been over millions of years through a process of rain, sun, cold, hot temperatures, has been disintegrated, and the rares have become loose and have attached themselves to clays. So a lot of the metallurgical process that the people who do hard rock, work on hard rock rare earth deposits now have to deal with, we don't have to deal with, because nature has already taken care of that. So, and also through this weathering process, a lot of the potential radioactive elements that do exist in deposits of this nature have also been minimized. And so that is also a key advantage. These deposits are usually shallow deposits. For example, Carina has a depth of about, average, I would say, about 20 meters. When you compare that to traditional mining, mines that open pit mines that sometimes have 500 meters of depth, you're really talking minimal depth. It's 20 meters, like I always say, is less than probably most of the underground parkings of buildings nowadays. So really the impact is very low. Because they're clays, it's soft material, all we need is a front loader to excavate the clays, truck them to the plant, and like I mentioned earlier, because of the process that we have developed, we, in essence, mix it with water, ammonium sulfate, that mix in a mixer, that allows the ionic exchange where the ions of the rares get detached themselves from the clays and into the water, and then through a process of decantation, we can create the ultimate carbonate. The water is recycled, it is cleaned. Of the plant, about 15% of the capex involved goes into our water treatment plant. That's how serious it is for us in terms of this process, but we believe that overall it's the right thing to do because the OPEX is very small, and also it's fully, it's a closed circuit that is fully environmentally friendly.
So simpler, cheaper, and cleaner process.
Absolutely.
And given that the ultimate destination of these is in electric vehicles, consumer products effectively, that's perhaps a key selling point for the OEMs.
Yes, it is. I think that and the fact that they've now, unfortunately for the world, realized that they can't depend on their key competitor, China. I mean, it was obvious what happened last year when China, because of the commercial dispute between China and the United States, said no more, export ban on rare earths. Factories had to close, or not close, but stop production for a couple of days because they just didn't have the key materials that they required.
Okay. Now, a lot of what you're doing is focused on the US market, a lot of the value chain you're looking at to develop. You talked about the facility in Louisiana, you're talking about the other plants, the metals plant to be in the United States as well. You mentioned you got a $5 million grant to help with the feasibility study there. Going forward, you said the US government has an option to sort of carry on funding the company going forward. You've got some great financing partners. You may not need that money, even if it is available. What's your wish list? What are your expectations from the US government? What do you need from them, or what will you need from them going forward, if anything?
So I think in the earlier panel, and going back to that, one of the panelists talked about what she described as mini-multilateralism. Let's face it, China is a formidable competitor. And for a company, not just us, any of the companies involved in this sector, to be able to compete against China, generate a new industry, is almost impossible without collaboration. And with collaboration, not just between companies, but also with governments. So what do we expect from not just the US government, but from the EU, Japan? We're talking to everybody. We're not just, let me take a step back. The fact that we have decided to put the separation plant in the United States doesn't mean that we're only going to sell the final product to the US customers. We may, but we're open to everybody. We're talking to, like I said, the Japanese OEMs, to Korean OEMs, to people in India, people throughout the world. The only country that we're not going to sell to, because it's our business model, is China, because we want to be independent. We want to be an alternative to the Chinese. So what do we expect from the U.S. government? Going back to your question, yes, we would love to have investment, even though we have 3 important shareholders. Having the U.S. government as a key shareholder is critical for us. We believe that it gives us a stamp of approval, shall we say, of support. I think that by also we would hope that the U.S. government can be the facilitator of bringing all the different players together in a table to find the right solutions for offtakes, for solving strategic problems that I'm sure will arise in the future.
Now, on offtakes, the US government last year made an investment in MP Materials, a rare earth producer in California. And one of the key elements there was offtake agreement, but also a price floor. To what extent is price flooring, those kind of things, to what extent are they desirable and important in this sector? Do you need an offtake from the US government?
So let me break down the question into several parts. We, as a company, we recognize why the price floor was made. I think it showed a very strong signal to the market that the U.S. government was serious about generating the conditions for this new industry to not only to solidify and to be a player long term, but we don't think that price floors is the way to go. We think that price floors going forward may not be sustainable. We do think that not just the U.S. government, but other governments need to look at how to make capital more competitive, the access to capital. China, doesn't have that problem. China invested in their rare earth facilities and industry 50 years ago, and they did so at zero cost. Basically, it was just state funding. So for companies like us who have to go out to raise money, we need to offer investors a return of 20–25%, and that makes our cost of capital, not competitive with China. Our OPEX, yes, we can compete. We can be as efficient as the Chinese, but what we need to do is, with the help of governments, reduce our access to capital, the cost of that access to capital.
I want to, with my next question, Jose, draw together various of the elements we've been talking about in terms of access to capital, having good partners, etc. Your ability potentially to supply markets elsewhere in the world, not just the United States. We're sitting here in Saudi Arabia. Saudi Arabia's got a lot of the conditions that Louisiana offers. It's obviously got a very long-standing oil sector and all the supply services there. It's got a metals sector as well. So you can potentially replicate a lot of the things you're planning to do in the United States here in Saudi Arabia. As the company develops and advances, is that something you're potentially considering, to replicate what you're doing in the United States here in Saudi Arabia?
The answer is yes. The Carina project is our first project in Brazil. We are convinced that Brazil has tremendous geological potential. We are exploring actively. We've already identified, potential areas of interest in several states in Brazil, and we're, of new greenfield projects, and we're hopeful, to be able to announce something in the next, let's say, 18 months. If that happens, and we're very confident that it will, we certainly will begin to develop that project with the intention of having also the separation facility either in Brazil, which is also a very strong candidate, or in a jurisdiction such as Saudi Arabia. Saudi Arabia definitely offers the type of requirements that one would need to do something like this.
Okay. Now, you mentioned, we're running out of time, so I'll be quick here. You mentioned the feasibility study is due in April this year, just sort of 3 months away. What other key catalysts can we expect to see from you this year?
Key catalysts are, I would say it's going to be a very exciting year. We need to get the feasibility study done by April. We expect to get both of our environmental licenses during the first semester of this year. With that, we're going to go out to the market to raise at least $100 million. Those $100 million will allow us to do the early works that we need to keep our construction schedule on time and have both mining projects in operation by 2028. So really, it's a groundbreaking year for us in terms of catalyst year in terms of meeting our objectives.
Okay, just on that $100 million, you mentioned some of the sort of key shareholders you've already got. I'm sure they'd be quite happy to write you the check. Going to market, though, does that give you a bit more competitive tension, perhaps minimize your dilution by going into the market?
Yeah, I think so. I mean, look, like I said, we have our three key shareholders that support us and will continue to support us. They have the right to, they have the preemptive right to do so, but they also believe in the story. So I have no doubt that they will support us. We also expect the U.S. government to continue to support us. The rest, you know, will raise in the market. We believe there's a lot of strong appetite for a story like ours.
Well, congratulations on a great 2025. Looking forward to the feasibility study when that comes out in a couple of months' time. Jose Palma, thank you very much for joining me today.
Thank you. Great seeing you again.
And now, moving on to our final presentation this afternoon, I'd like to welcome Roger Baxter, Executive Chair at Southern Palladium. Palladium, obviously a precious metal. It's one that's perhaps been overshadowed in recent times by gold and silver, but Roger's going to tell us why we shouldn't be overlooking palladium. Over to you, Roger.
Thanks. Let me come up here. Oh, there we go. Thank you very much. So, Paul, thank you very much. Just to say, we are not going to be a palladium company. We are a platinum group metals company. We'll be producing 400,000 ounces of platinum group metals on an annual basis. And so let me just kick off by saying that let's jump into the statement first of all. I'm sure all of you can read the fine print at the bottom last paragraph. We won't test you on it, but let's just jump into the main part of the presentation. So, why platinum group metals? Let me just say platinum group metals have been declared as critical minerals in all major industrial economies, and that includes the US, Canada, the EU, the UK, Japan, South Korea, China, and India, and Australia, and including South Africa. So what are they used in? PGMs are used in multiple different uses, but they are definitely some of the best catalysts known to humankind, especially at high temperatures. And if you think about the impact that PGMs have in autocats, in certain parts of electronics, in medical applications and technologies, for example, in pacemakers, 600,000 pacemakers are installed in people's bodies on an annual basis. Every single one has got a bit of platinum in it as electrodes. So just to highlight, PGMs are definitely at a global level. They are a group of precious metals. They're very scarce. And in fact, if you think about it, if you take all the platinum mined in the history of humankind, it would fill up an Olympic-sized swimming pool ankle deep. If you take all the gold mined in the history of humankind, it would be about 4 Olympic-sized swimming pools. So it just gives you an idea of the scarcity of PGMs. The best performing precious metals in 2025, the top of the list was actually ruthenium. Ruthenium is used in hard disk storage technologies, and it's a platinum group metal, followed by silver. Followed by platinum up 113%. So PGMs have been amongst the best performing precious metals in 2025, and we certainly anticipate that will continue in 2026. Structural deficits, not a huge amount of investment in new supply over the last decade, and nice growing and sustained demand profiles in catalytic converters, in industrial applications, in jewelry demand. More than 2 million ounces goes into jewelry demand in platinum as an example, and then obviously into investment demand. Just to quickly chat about Southern Palladium, we are an ASX listed and JSE listed company, so we're both on the Australian stock market and on the South African stock market. We have a market capitalization at the moment of about 300 million Australian dollars, quite a narrow share base of about 125 million shares on issue. Most companies at our stage of development have got more than 500 million shares on issue, and we've got a fantastic joint venture in terms of a partnership with our community in the area, the Bengwenyama community, through their special purpose vehicle, which is called Neuronox Investments. They basically own 30% equity stake in the underlying asset company, which we've nicely named as Miracle Upon Miracle Investments. They see this as a great opportunity to uplift their community over time. That's a bit about the company. Our current share price is sitting at about $2.30 on the ASX. That's Australian. Where are we located? The project is located in prime PGM mining real estate in South Africa. And in case you didn't, if you're not aware of this, South Africa has 86% of the world's known platinum group metal reserves. and is the home of the production of 70% of the world's platinum group metals. The only other country that really produces a major amount of PGMs is Russia, producing about 40% of the world's palladium. A little bit from Zimbabwe, a little bit from Canada, a little bit from the US, but the majority comes out of South Africa. We're up on the far eastern limb of the Bushveld complex. We're in an area which is basically already well developed, and in fact the project itself kind of like slipped through the cracks a bit, and we were fortunate enough to get to work with the community on helping to now develop it, and so it's one of the last major PGM assets on the eastern limb of the Bushveld complex that's going to be developed. This is just to give you an idea of, in the area, Eskom substations, water reticulation from the Lebelela water scheme right next door, well-maintained road networks, ferroalloy smelters right next door, and a well-developed mining supplier park system around our particular mining area, with a project on the bottom left over here. Let's jump to the next one. So we raised $19 million Australian in 2022. We have proved up a 40 million ounce inferred and indicated, and a 6 million ounce reserve according to JORC 12. So it's a really plum deposit, nice high grade in situ. Our mill feed grades are, sorry, let me just start. Our in situ grades are sitting at above 9 grams per ton on a 60 ounce basis. On a mill feed basis, we're going to be looking at about 6 to 6.5 grams per ton. So this is real prime deposit. On the right-hand side, you'll see a number of our other competitors. We've only done exploration work. We've done about 35,000 meters of drilling, slightly more than is indicated. We've got 7 drill rigs on site at the moment, and that's just proving up, doing a little bit more on our met work side. And we did deliver a nice metallurgical sample to our met consultants last Friday, 146 kilograms of PGMs, which I'm sure will continue to reinforce the progress we're making. Quick aerial photograph of the site. You can see on the bottom right-hand side, or the eastern portion of the farm, is where we've done most of the work. And we've split it into 2 stages. Stage 1 being the south decline. It's nice and shallow. We will be intersecting reef at 50 meters. 50 meters, very shallow. Just remember, on the western limb of the Bushveld complex, some of the deeper level mines are operating at 2 kilometers depth. The ambient rock temperature is about 60 degrees centigrade. We won't have any refrigeration or cooling on this mine, probably for the first 20 to 30 years of mine life. Just jumping in quickly, we initially did a PFS, which came out in 2024. Our pre-feasibility study gave us a $1 billion post-tax NPV, but quite a steep price tag, a $450 million US peak funding requirement to develop the overall mine. So as a typical Australian company, because obviously our headquarters are Australian based, the idea was, okay, well, let's do it the typical Australian way, which is let's do a 2-stage project development. And a 2-stage project development, stage 1 is modular, south decline, again, as I said, intersecting reef very early at 50 meters. And the idea is that's substantially reduced our peak funding requirement, down by 38% to 279 million. And obviously with our market cap having picked up very nicely in the last few months, we're now sitting at a $300 million Australian dollar market capitalization. So on a 50-50 or 60-40 debt to equity basis, much more fundable from a project level perspective. Got a very nice post-tax NPV now, with prices having risen quite nicely. Our current post-tax NPV is sitting at about 1.3 billion US. So that compares to the 857 million that was in our optimized PFS. And our IRR, internal rate of return criterion, is over 30% once we've added in stage 2. So it's a very nice cash generative project. On a costing basis, our all-in sustaining costs are at the lowest end of the cost curve. That's because we have a mining width of about 1 meter, so our grades are nice. As I mentioned, our mill feed grades are going to be sitting at about 6.5 grams per ton on a 60-ounce basis. And at a global level, that's very, very good. We have a less dilution than some of the mines to the north of us because they have to mine out a certain portion of their roof wall, which we don't have to do. And obviously, we're very close to the surface, so that really helps us in the process. So once we get to steady state mining and include stage 2, we're going to be producing 400,000 ounces of platinum group metals on an annual basis. And that includes 150,000 ounces of platinum, 150,000 ounces of palladium, 50,000 ounces of rhodium, 350,000 tons per annum of high-grade chrome, which is 43% chrome content, but I'll touch on that in a moment. This was just the 2 stages. Stage 1 being the red bars, 100,000 ton a month of ore being produced. Adding in stage 2. Stage 2 will be completely funded from the cash flows of stage 1, and that's because the project is so cash generative. And at this particular stage, we've got a 33-year mine life, but obviously we've only explored half the farm. So I'm sure we'll add a lot more to the reserve and resource base as we take the project forward. Just to highlight on the top right-hand side, the biggest revenue spinner to us is actually rhodium. As I mentioned, we produce about 50,000 ounces of rhodium a year. The current rhodium price is roughly at $10,000 an ounce. Obviously, rhodium is used in very special autocatalytic converter applications. Second is platinum at about 28%, 26%, palladium at about 24%. And then we've got a couple of other PGMs in there, including ruthenium. And as I mentioned, ruthenium's up 158% last year. That's used in hard disk storage technologies. The chart itself basically just demonstrates our post-tax cash flows. The project is very, very nicely cash generative. The left-hand chart is all about stage 1, but it's better to include stage 2. Stage 2, at current prices, would be generating $300 million plus per year free cash flow post-tax. Just gives you an idea of how incredibly cash generative the project is in the process. Last couple of slides. This is an aerial photograph of our southern decline box cut and associated mine workings. We're at the DFS level at the moment, definitive feasibility study level. We're probably 80% of the way there, and we'll be finished that probably by the end of the second quarter. So it's very, very soon in terms of our DFS level work. And as mentioned, we are doing an additional 10,000 meters of drilling. That's mostly geotech and met drilling, and we'll do a bit of infill drilling at the same time. One thing that's interesting about that slide is you can see there's no housing that we need to move in the south decline. So again, the community have been fantastic to work with, and the area is pretty open for us to be able to put in place the south decline. Just jumping, this just gives you a quick detailed view of the drilling, the drilling that we're doing at the moment, but of the extra drilling that we're doing. And again, none of the results are different to what we expected, so all looking pretty good, and we'll come out in the next couple of months with new additional metallurgical results in due course. So, second last slide. This is our PERT chart in terms of our timelines. We're expecting the granting of our mining license literally in the next month or so. We've done a lot of work with government to get there. It's quite an interesting and involved process, but we're nearly there. We are going to finish off our DFS level studies by the end of the second quarter into the early third quarter. We're expecting to complete FID by the third quarter of this year. Everything's progressing according to plan at this particular stage. We've just raised 20 million Australian dollars in November in a two-tranche placement, and that $20 million, in addition to our existing cash resources, takes us way beyond FID. But what we are going to do once we've got the permits is we're going to start early decline development at the beginning of April. Obviously the 2nd of April, not the 1st. And that's because we are so confident of the geology and of the nature of the particular ore body. We've got a board which has got more than 200 years of mining experience that is focused on the project. And early decline development, we'll be intersecting reef and hitting reef at 50 meters, probably by the end of the third quarter. That's how quickly we'll get to that. That'll make us basically 9 months ahead of our initial plans around start of the mine development. And we're also looking and exploring the opportunity for a prepaid or chrome stream on some of our chrome. That'll give us an additional quantum of money that we'll be able to use for further development and opening up of areas for mining. And again, that's all enables us to develop the project a lot faster. Again, it's close to surface, high grade, low cost, and we're making an early start, which is always a good thing to do in a project of this sort of nature. So my last slide, fantastic geology. You can't fault the geology. Even when we do take results from some of the drilling that's been done around our boundary fence, the contiguous nature of the ore body is actually really good. And so that's worked out really well. The optimized PFS gives us a really great post-tax NPV and project economics, low cost, high grade, great NPV, great IRR, great community, and we've been working closely with government, and we're pretty close on all our permits. We're a very cheap entry point on an economic value per reserve ounce. It's currently gone up to about $20 per reserve ounce at the moment, but that's still pretty cheap compared to most of our competitors. So great opportunity. And a number of shareholders. In our recent placement, we had 3 foreign institutions that came on board from the US, the UK, and from Europe. And it just demonstrates that people are becoming a lot more comfortable with much greater exposure to PGMs as a hard asset precious metals class. So thanks very much for your attention, and looking forward to answering a few questions with Paul.
Thank you, Roger. Please take a seat. Now, the next main catalyst, if I understand correctly, the feasibility study. You mentioned you should be finished up there with the work on the second quarter. When do you expect to be able to publish that and make it public?
Paul, we are expecting that we'll finish that in the second quarter, so we'll probably publish it early third quarter. Again, we've got a fantastic team of consultants working on the DFS level work, and we're combining in the bankable feasibility study angle into that. We've got great support from our debt advisors, a company called Blackbird out of Australia, who are helping us on the debt funding side. And so working with them, meeting all the requirements to make sure that we can produce a bankable feasibility study, DFS at the same time, is what the target is. And we're expecting that all that work to be completed by the end of the second quarter, published.
Study optimization you've been talking about.
It's always really important, Paul, to compare apples with apples. So our view is that we'll use the original price deck that we used in the original PFS and then the optimized PFS, so you're comparing apples with apples. It will be 30 to 40% lower than current prices. Still, the project is incredibly economic and viable and valuable. So, why change that formula and allow the comparisons to take place?
You're going to let everybody work out the upside on their own?
Well, I think we've done that already. I mean, for every 15% increase in the basket price, we get about a $200 million increase in the post-tax NPV.
That's quite nice, isn't it? Tell me a little bit about the power situation in South Africa. Recent years, there's been challenges there, and that has been a bottleneck or held back mineral developments in other parts of the country. What's the power situation in the area where you are?
So just to say, there were some challenges a couple of years ago. There's been no load shedding in South Africa for the last 2 years, so your news source is not giving you the most up-to-date information. Basically what happened in South Africa is that government and industry and government and business after COVID realized that working together was a much better solution than competing with each other. And so business and government set up a National Electricity Crisis Committee where both cabinet and senior business leaders, I was actually involved in that, in the establishment of NECOM. And that was really designed to help liberalize South Africa's electricity market. In mining alone, we unlocked 36 projects with 10 gigawatts of new renewable energy coming on board. And several mining companies are already producing electricity from their own plant. And at the same time, Eskom has been reformed. And so, yes, the answer to your question is there was a challenge. That challenge has been overcome. And it's been fantastic to see the liberalization of the electricity market. And government have met their commitments in terms of an independent system market operator, the establishment of a national state transmission company, the allowance and fast-track licensing of renewable energy generators to come in and supplement the network. And so, yeah, it's in a much better space than it was a couple of years ago.
Okay, so one of the upshots of that is you don't necessarily need to put in your own power supply.
Well, actually, what we're going to do is we've already started the work towards connecting onto the Eskom network, because obviously Eskom still control the network. But we'll probably get the majority of our electricity from renewable suppliers. And what's important about renewable suppliers is they can be operating in the Northern Cape. We up in the Limpopo province, maybe 1,200 kilometers away. But the national network, you pay a nominal network charge, and you should be able to theoretically get the electricity from the Northern Cape basically being supplied in Limpopo. So the liberalisation of the market is very much about opening up the market to competition, and we can basically choose who we want to get supplied by, and that will not only help us meet our emission targets, but it'll also enable us to probably lock in a fairly constant electricity price over time, a bit of a price hedge.
Excellent. Well, happy days there on the power side. Now, 400,000 ounces per year production after the second phase, very attractive, 33 years. Bengwanyama is located close to existing mines, and you've got some very big players in the PGM space in South Africa, Ivanhoe Mines, Implant, Sibanye, Stillwater. Is the strategy to become a producer to join those, or do you see your future more as being bought out by one of these big guys?
Our objective is not to, we're not waiting for one of the majors to come and buy us out. I'm sure they are interested. No, our objective is to develop the project, to continue to de-risk the project. We've got more than enough capability. The skills are available. The mining supplier and contractor services are readily available in South Africa, et cetera, et cetera. So, at the same time, we've also been working in partnership with some of the companies already in terms of how you manage interactions with, from a social level with the communities in the area, something called the Southern Cluster, where there's a number of other PGM mining companies operating. So, there's a lot that one can collaborate on, but at this stage, we're looking at developing the project ourselves. At the same time, we have a couple of interesting options that do come out. In the short term, we are exploring a couple of ideas of using third-party concentrator plant in the area to concentrate ore. So it would be an ore offtake arrangement to generate early cash flows, whilst we built our own concentrator plant on site, because remember, a concentrator plant takes a couple of years to build, and that gives you early cash flows. And then the second stage of that is we would need to have a smelting and refining agreement with one of the majors at a particular stage, and that's something that we'll work on once we've got the DFS level work finished.
Okay, tell me a little bit more about the possible chrome stream you mentioned. Would that be similar to, let's say, a copper mine selling a silver stream or a copper mine selling a gold stream?
Yeah, absolutely. So remember, in this particular process, the chrome is basically spiraled out up front using dense media separation, or spirals as we call it. So you end up with a separate high-grade chrome concentrate. That high-grade chrome concentrate is then used on the basis of you can then either sell it or do it as a prepaid. So a prepaid or a stream is exactly that thing. You get paid up front, provided you deliver into that particular contract, or you can virtually deliver it in, depending how you set up the financial structure. And that's quite a nice short-term funding option that you can put in place. So we are exploring that, and our capital advisors out of London, Bacchus Capital Advisors, are working on that particular part of the program. 350,000 tons of high-grade chrome ore is a nice revenue contributor, and obviously it's in demand at a global level because it's very much part of the global stainless steel industry.
Okay. Now, you mentioned the possibility of making a final investment decision in the third quarter. The chrome stream you've just mentioned, I imagine you're quite well advanced in conversations about putting together the financing package. If you could put together your wish list of the financing, what would that look like?
At the moment, I mean, we've funded almost the entire project out of the progress to date has been using equity from both our cornerstone investors, who've been fantastic to support us through the process, but then also through other shareholders that have come on board as we've got the company more out into the marketplace. A lot more people realize that PGMs are a great asset class to invest in, and that Southern Palladium is a fantastic share to invest in, and that's why we're seeing the share price having risen so nicely. At our last capital raise, we did it at $1.10. The current share price is sitting at $2.30. So, so on the equity side, we're confident and comfortable that that's been working exceptionally well. Obviously, we're going to a debt equity arrangement when we do get to the funding, to the specific funding stage. Our prepaid or stream arrangement that we get into place won't have an impact on our CFADs, cash flow available for funding debt. So, we're just working on that very carefully. But we're looking at a number of different options there. It might involve a bit of DFI funding along the way. But again, it's going to be, we are engaging with a number of the banks through Blackbird, our debt advisory company. And we've met directly with a number of the banks. And obviously, as we progress the project and get it through to the DFS bankable feasibility stage, we'll be at that stage where things will become a lot clearer in terms of which banks are going to come in, who's not, et cetera, et cetera.
Thank you. I'd like to ask you a little bit about one of the key markets, and obviously that's the catalytic converters. With the European Union and the US pulling back on penetration rates for electric vehicles, incentives to purchase electric vehicles, what impulse or boost do you think that gives internal combustion engine markets?
So, Paul, I think the world has gone through a remarkable sort of shift. About 3 years ago, if you talked about battery electric vehicles, everyone thought that battery electric vehicles were going to wipe out platinum and palladium and rhodium. The view was, EVs would just, battery electric vehicles would basically, that's a bit of a simplistic view of how the world works. In reality, battery electric vehicles have a place. But what's been interesting is that battery electric vehicle growth rates in demand have come off a bit. They grew about 20% last year, but the point to make is that a lot of people have rather started going for hybrids, offering them both. It deals with some of the anxieties that you may have if you're driving a pure battery electric vehicle. It's not about range, it's about recharging anxiety. And for some people, it's about resale anxiety, about whether you're going to get any value for the vehicle when you sell it. And so it's been interesting to see how many of the large-scale automotive companies outside of China have elected to sort of dampen a little bit their pure battery electric vehicle drivers, gone more for the hybrid side, and then obviously the other side, which is becoming and gaining a lot more attention, is hydrogen, especially in heavy-duty transport. That's hydrogen proton exchange membrane fuel cell, and so watch that space. That's been quite an interesting space to watch.
Okay, now you've told us about many things that are going to happen this year, but let's put them in a list of what are the key catalysts. You mentioned the feasibility study, you mentioned the final investment decision. What else can we expect to see out of you this year? So
short-term mining license, really big item now coming up hopefully in the next month or so. Mining license. Second, we'll be producing some further MET and geotech type results over the next few months in terms of the progress that's come out of that. We'll have the DFS, BFS coming out towards the end of the second quarter, early third quarter, FID. And then, obviously quite excited about the concept of the early decline development, going down and being able to touch the ore body at 50 meters. Probably by the end of the third quarter is going to be an exciting development. And then obviously we've got our potential agreements that may be reached in terms of either an ore offtake agreement in the short term or the longer term smelting and refining agreements. Those will become much clearer over the course of 2026. So it's an exciting year for the company. And from our particular perspective, been great to have the support of our cornerstone shareholders and the new instos that have come on board. And in my view, PGMs have got a lot more room to grow from a pricing and from a feeding into the revaluations of companies' perspective, and Southern Palladium's, very much a cheap entry point and a great place to be.
Well, excellent. Well, congratulations on what you've achieved so far. Looking forward to seeing all these catalysts being hit this year. Looks like a very good year for you. Roger Baxter, thank you very much for joining me today.
Paul, thank you.
That concludes our session this afternoon. I'm Paul Harris, as I say, with Mining Journal and Kitco Mining. Thank you very much for sitting with me.
Thanks, everyone.